Okay, my dear friends. So here we have a very interesting question. Institute said it is a part of security valuation chapter, but I have included all these equity related items in corporate valuation chapter. According to me, these are all related to equity. Let us read. This is not actually under regular equity valuation, debt valuation, slightly different problem. And these are the ones you can expect in exam. Let's read the question. Rahul Limited has a surplus cash of 100 lakhs, wants to distribute 27% of it to the shareholders. So 100 lakhs, 27%. So 27 lakhs. You want to pay dividend over. The company decides to buy back the share. So they're not paying dividend, they're going for buyback. Logically, even practically, we have done in our company buyback only because buyback is a less tax as compared to dividend. Anyway, that's a tax planning aspect. Let us not worry about it. Company decides to buy back the shares. So they have 27 lakh. Using that, they want to buy back the share. The finance manager of the company estimates that the price after repurchase, meaning after buyback, is likely to be 10% above the buyback price if the buyback route is taken. So market price will be 10% above the buyback price. What is buyback price? I don't know, but it will be 10% above that. The number of shares outstanding at present is 10 lakhs. Current EPS is 3 rupees. You are required to determine the price at which the shares can be repurchased. If the market capitalization of company should be 210 lakhs after buyback. The number of shares that can be repurchased and impact of repurchase on EPS, assuming that net income is same. Okay, these are many interesting questions here. First of all, how many shares are there now? Very good. 10 lakh shares are there. How many number of shares you are going to buy back? We don't know. How many shares will be, what is the buyback price? That we don't know. What is the current market price? At least do we have that information? That is also not known. So lot of missing informations are there in this problem. Only something which is closest one is it is likely to be 10% above the buyback price. And after buyback, the company wants to have a market capitalization of 210 lakhs. Now, sir, very easy, sir. We can compute market price per share. How? They want to have market price of 210 lakhs. Very good. Divide by number of shares. How many shares? The number of shares we have. Number of shares is 10 lakhs. No, this is after buyback. And after buyback, number of shares will reduce. And that we don't know how much it is. You're getting the point? So we have to do some simultaneous equation kind of calculations. Anyway, so let's write down together. So the information what they have, let's go based on that. That is, the company should have market capitalization after buyback. So let me use that information which we have. Market capitalization after buyback. How do you calculate market capitalization? Number of shares multiplied by market price per share. So market price per share, I'll use short form MPS, after buyback multiplied by number of shares after buyback. Correct? And what should be the market capitalization after buyback? That they have given as, this should be 210 lakhs, that they have given. This should be 210 lakhs. And what is the market price after buyback? I don't know. They just told it is 10% above buyback price. So let me assume, let's say P equals buyback price, and 10% above that means it will become 1.1. I mean 10% means 0.1. So 1 plus 0.1, 1.1. So market price after buyback becomes 1.1 P multiplied by number of shares. What is number of shares after buyback? Existing shares minus buyback shares. What is existing shares? Existing shares is 10 lakh minus number of shares bought back. How many shares are bought back? That we don't know. But we know one information. Amount you are going to use 100 lakhs into 27% means 27 lakh. This is the amount which you will use for buying back. And what is going to be the buyback price? You will divide by P. See if you're able to get this calculation. 210 lakhs is the market cap that we want to achieve, and number of shares multiplied by market price per share. On market price per share, I've taken 1.1 P, because if I take buyback price as P, after buyback becomes 1.1, 10% increase. Number of shares, existing shares minus shares bought back. Sorry, I think I've written, yeah, correct, it's fine. Existing shares 10 lakh and minus the number of shares bought back, 27 lakhs is the amount you require that you're using for buyback divided by P. So amount by price gives you number of shares bought back. And we just have to simplify this now. So let me cross multiply. So that lakhs, I'll forget about it, 210 lakhs. Everything is lakhs only. So 1.1 P. This I can multiply 10 lakhs into P. That is 100. So 10P, sorry, 10P minus 27 lakhs remains as it is divided by P. P and P gets cancelled. So 210 equals 10P minus 27. Minus 27 comes to left side. So 210 plus 27 equals 10P, or 10P equals 210 plus 27, 237. 1.1, sorry, I forgot. 1.1 is also there, no? Yeah, I think I missed 1.1. This into 1.1 was there. Just one second, let's simplify. Into 1.1 was there. So 210, 10P into 1.1, that is 11P. 10 into 1.1, 11 only, yeah. Minus 27 into 1.1. 29.7. That comes to left side. So 210 plus 29.7 equals 11p. So 11p equals 239.7. So p 239.7 divided by 11, 21.79. So this is the buyback price per share. Buyback price per share, 21.79. Then that's what they asked in the first part of the question. The price at which shares can be purchased, yes, 21.79. So please go through it. See if you have any doubts. Can you explain why you multiplied by P? You mean this step? Are you talking about this 10 lakhs into P? Why I multiplied in the calculations? I did 10 into P. I just want to know whether that is the point you're asking. No. Next step. Yeah, next step only. Next step 10 lakh into P, it became 10P. That's what you're asking, right? How the 10P became? Because I multiplied. Yes, okay. So in mathematics, when you have a fractional simplification, we multiply like that. See, for example, if it is 1 minus 2 by 7, if I want to calculate, what I'm going to do, I'll have to make the denominator same. So what I'm going to do, I'll have to multiply it by 7 and divide by 7. So denominator becomes same number. Or other way of explanation is this, we multiply like this. 7 into 1, 7 minus 2 divided by 7. And what is the mathematical explanation? I'm actually multiplying by 7 and dividing by 7 and making the denominator same, and I write only one time denominator. Instead of calculating like that, what we do in mathematics is whenever we have a number full, another number fraction, we simplify it by multiplying this. So that's what I did here. Here we had 10 lakhs. Here we had divided by P. So I have multiplied 10 with P. So basically in both the places, I got the denominator P. So I wrote it only once. I hope this is fine. Great. Okay. So first part of the question we did buyback price. Second part, number of shares that can be repurchased. Once we know the buyback price, amount we know, so let's use it. Number of shares bought back. Number of shares bought back. That is the amount of buyback divided by buyback price. Amount of buyback divided by buyback price. Amount of buyback, you see 27% of 100. So we took 27 lakhs. So 27 lakhs divided by 21.7. 1.239. So let's say 1.24 lakhs approximately. Okay. Then they've asked what is the impact on EPS. So existing EPS, they only have given 3 rupees, so it will be the new EPS. New EPS, profit after tax divided by number of shares. So let's calculate new EPS. And they said the profit after tax remains same. How much was profit after tax? Previously, they have got EPS of 3 rupees and they have got 10 lakhs. So number of shares 10 lakhs, EPS 3 rupees. So can I say PAT is 10 lakhs into 3? Each share is 3 rupees. So must be 30 lakhs. This is the profit after tax divided by number of shares. Previously it was number of shares 10 lakhs minus number of shares bought back, which is 1.24 lakhs. Number of shares will come down. So what will happen? 30 divided by 10 minus 1.24 means 8.76. So 30 by 8.76, you get 3.424. Let's say 3.4. So EPS, which was 3 rupees, now becomes 3.42. So you can say increase in EPS. .4. Impact on earnings, impact on EPS increased by 0.4. Okay, so this is one special variety. It is an RTP problem. Actually, it was also asked in some examination some time back. And these are some special variety problem which can definitely repeat in examination. Okay, I hope it is done. Let's go further. Okay, let us take up this problem now. This is one more repeatedly asked question on bond replacement decision. Before I read this problem, let me give you the context very quickly. For example, you have an existing home loan with SBI and Bajaj Finance will call you and tell, do you want to switch the housing loan? We'll give you at a lower rate of interest. That is the decision we are trying to make it here. A company would have issued a bonds, a loan for a company after all, and it was issued at such a point in time when the rate of interest was high. But even if the market rate goes down, the company cannot take the advantage of it because the company is committed. So what they can do, the existing bonds they can redeem and new bonds they can issue at a lower rate of interest. Of course, this process will have certain cost. The question is, does this cost justify the benefit? That is, what you save in interest is what we have to answer in these type of problems. Let's take a look at it. So come to this question. Let us read. ABC Limited has 300 million 12% bonds outstanding with 6 years to maturity. Interest rates are falling. ABC Limited is contemplating of refunding these bonds with 300 million issue of 6-year bonds carrying coupon rate of 10%. Please observe the rate of interest. The present coupon is 12% and market is interest rates falling. So the company can issue the bonds at New coupon rate of 10%, you're going to save 2%. The 2% is going to have a tremendous savings as far as annual cost is concerned. Issue cost of the new bond will be 6 million and the call premium is 4%. Issue cost, you understand? Whenever you issue a new bond, it will have some expenses. That is what is issue expenses. And you have a call premium. Call premium means when you redeem the existing bonds earlier than maturity, it has 6 years remaining to maturity. When you redeem it earlier, you have to pay a penalty. That's called as call premium. Even in housing loan, such concept exists. You have taken a loan for 20 years. After 5 years, you got some bonus, you got some surplus, you want to clear off the loan, you want to prepay the loan. If you pay the money, then the bank will lose interest opportunity. So whenever you pay the loan in advance, you pre-close your loan, bank will levy a penalty, pre-closure charges. That's what is called premium. It is an expense because you are redeeming the existing bonds earlier than original maturity date. 9 million being unamortized portion of issue cost of old bonds. What is this unamortized portion of issue cost of old bonds? When you issue a bond, there will be some issue expenses, and those expenses for taxation purpose. Different countries might tell different things. We are trying to do as universally as possible, so we go by conceptual basis. The conceptual basis is you have a bond, and for the bond there is an issue expense, and this expense will not be taken immediately to P&L for tax purposes. As long as the bond is outstanding, the period over which the bond is there, the same period, these bond expenses are to be amortized. Issue expenses are amortized over a period of the term of the bond. But if the bond stops in between, meaning you're redeeming in advance, then there will be some expenses yet to be expensed, issue expenses yet to be amortized, and that is called as unamortized portion of issue cost of the old bonds. And that again, for tax purposes, different countries can tell different things. Keeping it universal, conceptual, when the bonds are having a certain term, the issue expenses are amortized in that period. If the bonds are redeemed in advance, these issue expenses are taken to P&L account immediately. So the tax benefit on these unamortized bonds will be obtained immediately. And please understand, my dear friends, we are not focusing on expense here. That is not what a financial management will look at. The objective is to ascertain cash flow. So the issue expenses have already been incurred. The cash flow is already done. So if you take it to just P&L account, that has no impact on cash flow. But when you offer it for taxation purpose, you will save tax, like a depreciation, tax saving will come. That is the impact we are trying to apply in this case. So unamortized portion of issue cost of the bonds is not important to us. Its tax benefit is important to us. Because the bonds are redeemed immediately, these expenses also taken to P&L immediately. As a result, the tax benefit is obtained immediately. So what is the relevant impact that we should consider is the tax impact of unamortized cost written off immediately, the tax impact, tax savings. So 9 million being unamortized portion of issue cost of the old bonds can be written off no sooner than old bonds are called off, meaning it is written off immediately and we save tax on that. Marginal tax rate of ABC Limited is 30%. You are required to analyze the bond refunding decision. Assume the tax impact on amortized cost and cost premium to be considered at the beginning of the year. I mean, that's not there. Okay. You are required to analyze the bond refunding decision. Okay. So ultimately, if I have to simplify the structure, whenever you get these type of decision making, especially long term, in this case 6 years, divide the cash flow into three time periods: initial cash flow, interim cash flow, terminal cash flow. Applicable for bond valuation, equity valuation, any type of capital budgeting decision, and so on. What are the three types? Initial, interim, terminal. For example, you're trying to buy a machinery. Today's purchase price machinery, initial cost. By using machinery, every year you get profit, interim cash flow. And last year, when the machinery term is over, you sell it, scrap it, residual value. Initial, interim, terminal. So here, initial cash flows are you have existing bonds, which is repaid, and the new bonds, which is received. And some issue expenses are there. So the information try to categorize into initial cash flow and interim cash flow. So what are the things which will come in interim cash flow? Every year you save interest. That is interim cash flow. And last year you redeem, that will be part of terminal cash flow. And in this problem, there are two types of things. See, for example, if I compare with the capital budgeting problem, we have existing machinery. Should I replace with the new machinery or not? It's an incremental decision. It's a replacement decision. So in that case, what are the relevant cash flow we should take? We need to apply incremental cash flows and we need to calculate incremental benefit by making a replacement decision. Do we get the additional benefit or not? So I'm going to solve the problem in a three column format. One column, if I continue with the existing bonds. Second column, if I replace with the new bond and incremental benefit, incremental impact. Institute solves in different way. I would like to follow this structural, systematic approach. Initial, interim, terminal. These are the different periods of cash flows. One system, one approach. Then the existing bond, new bond, incremental cash flow. This we are going to calculate overall net benefit. Now, as far as initial cash flow is concerned, that is already in present value terms. Whereas interim cash flow will occur every year. So to bring it into present value, we'll apply annuity factor. Every year cash flow is same. And last year, we'll apply discounting factor. Thereby, we get net present value. If it is positive, the decision is to accept. The decision is to replace. Just to be on a lighter note, you can also understand like this. Your existing bond is your existing maybe girlfriend or boyfriend. Just for example purpose, don't take it personally. And when you are with the existing person, you find some more person, one other person more attractive. So you need to have a breakup here and enter into a new relationship. And for breakup, there will be a breakup expenses. And for entering into new relationship, there will be new relationship expenses. The breakup expenses here is called as call premium. And the new relationship expenses is called as the fresh issue expenses. Anyway, Just for example purpose, do not take it personally. Okay, so let's solve it in a columnar format. Everything rupees million. One more point I would like to address it here. We need to compute the NPV, net present value. For that, we need discounting rate. And what is the discounting rate? Once again, I'll just get one question. Let me read. We don't find another one, then other person finds someone else more attractive. That is a recurring process, and that is an opportunity cost which will always exist. But we are only comparing two situations. You are into a commitment, you are planning to a fresh commitment. You are having existing bonds, you are finding new bonds more attractive. Anyway, at least these things are more contractual, more reliable, numerical. So it is definitely, I mean, I'm talking about bonds and not talking about anything else. Okay. I'm talking about discounting rate. If you want to calculate the present value, you need the discounting rate. Now, discounting rate they've not given directly. Cost of capital of the company is considered as discounting rate. Cost of capital not given. So in that case, rate of interest will be taken as a proxy for cost of capital. But two rates of interest are there. We have 12% and also we have new bonds which is at the rate of 10%. Which one is relevant? New bond is relevant, that is the existing market rate. So 10% will be taken as the proxy for cost of capital. But one small point, because they have given the tax information, all our cash flow will be after tax. When cash flow is after tax, the discounting factor, discounting rate also should be after tax. And therefore, when the cost of capital is not given, you take the rate of interest as a proxy for cost of capital. And in that case, the rate of interest should be multiplied by 1 minus t so that we get the discounting also after tax, cash flow also after tax. Okay, so keeping those things in mind, let's prepare the format. You continue with the old bonds, you replace with the new bond, incremental, initial cash flow, interim cash flow, and terminal cash flow. So we are going to follow this systematic approach to get the answer. Okay, so if you continue with the old bond, today you don't have to do anything, zero cash flows. But if you decide to replace with the new bond, there will be lot of cash flows. New bonds, you will receive the money, and old bonds you redeem. So it is minus 300. And old bonds you redeem at a premium like a pre-closure charges at the rate of 4%. So minus. But this is allowed for tax purpose. So we take it after tax. After tax means into 1 minus 0.3. And old issue expenses are there. New issue expenses minus 6. This I will not take into 1 minus t. Why? Because these issue expenses will not be recognized immediately for tax purpose. This new bond will have a remaining time. So we'll spread across remaining time. And old unamortized tax expense are there. I told you unamortized issue expenses. You get the tax benefit immediately. You multiply it by 30%. So please take a look at this very carefully. Some things I'm just taking the amount as it is. Some amount I'm multiplying by 1 minus t and some amount I'm multiplying only by t. Different varieties are there. See if you're able to understand conceptually. Write down till here. And if you have any questions, please shoot. Write down till here. Uh, Let me know once you're done. And if you have any if you have any doubts, please go ahead. As I told you, I am solving the institute problems only, but the approach is different. Sometimes I follow the institute approach as it is. Sometimes when I feel that it can be presented in a better way, we are following this. Unamortized cost will be fully transferred to P&L, hence we take the tax benefit. Absolutely correct. Unamortized cost is fully transferred immediately to P&L, and therefore we are taking the tax benefit immediately. Okay, so now calculate the all net benefit now, that is 300 minus 300 minus 8.4 minus 0.6 plus 2.7. If I consider all of them, 11.7 again. And therefore incremental cash flow 0 if you continue, minus 11.7 million if you replace. So incremental is second column minus first column. Incremental cash flow is subtracted by second column minus first column. Okay. Then we'll come to interim cash flow. Now, before I go further, can you try and tell me, if I continue with the old bond, what is my periodical cash flow will be? I'll have to pay coupon, right? That is what? Interest. Minus 300 into 12%. And after tax, all our cash flows are after tax. So into 1 minus 0.3. After tax means you multiply it by 1 minus 0.3, 1 minus tax rate. And I'm putting minus number because cash outflow means I'm putting it as minus. Stick to the structure. If I replace with the new bond, it will be minus 300 being outflow at the rate of 10%, and after tax means I multiplied by 1 minus 0.3. So when I calculate incremental, this is also minus, this is also minus. So what should I write? Incremental approach. It is going to be minus, or is it going to be plus? The answer is plus. Why is that? Because earlier I was paying 25.2. Now I pay only 21. My expense is getting reduced. I'm saving, isn't it? And in fact, this is the primary purpose for which we are discussing this problem. The savings in interest is the primary driving factor why this problem is being discussed. If you want to calculate mathematically, I told you it is second column minus first column. Second column is minus 21. First column minus 25.2. So minus of minus becomes plus. So minus 21 plus 25.2, you will get 4.2. I hope you got the answer, mathematical as well as conceptual. Apart from this, there is one more cash flow which take place. Many people miss out on this. Please be more careful. And that is issue expenses. If you continue with the old bond, the old expenses would have been amortized. It will not be amortized immediately. Every year, this expense will be amortized. If you replace it with the new bond, the old bond expenses unamortized cost is recognized immediately, but new expenses are there. You remember, we have taken minus 6. We have not done into 1 minus 0.3. That tax benefit will come every year. And we are not talking about the expenses here. We are talking about the tax impact on those expenses. It is a tax savings on those expenses. So the old bonds were unamortized cost. You see, 9 lakh we have taken, remember? That 9 lakh is spread across 6 years, 1.5 lakh per annum, and 30% is the tax benefit. So positive number. If I replace with the new bond, then the issue expenses 6 lakh will be spread across 6 years, and on the tax benefit of 30% comes to 0.3. So what is the difference? Mathematical, second column minus first column, 0.3 minus 0.5, 0 minus 0.15. What is logical benefit? If I continue with the old bonds, I will claim 9 lakh expense. If I go with the new bond, I'll claim 6 lakh expense. Expense is less. So when expense offered is less, tax benefit is less. So you lose to that extent. In fact, the difference may be minus 0.15. The positive number, I mean, the number wise, its impact is not much. It is not going to have impact on your decision making. NPV will be still positive or negative. Minus 1.15 may not make the difference, but it will make a difference to your marks. They do consider, they do allocate marks for these things. So please be careful. And terminal cash flow, if I continue with the old bond, I'll redeem at face value. When nothing is given, we'll take it redeem at face value. New bond also redeem at face value. So no incremental impact on terminal cash flow, nothing is there. Now, these cash flows are taking place at different point in time. All of these things I have to bring it into present value. How do I do it? This is already in present value terms. I don't have to worry about it. Now these two things I have to multiply it by annuity factor. Then I'll get present value. This is anyway last 1 year, but if I have to apply, I multiply it by discounting factor and that will give me present value. And then I can calculate net present value, or I can do it individually. So write down till here, see if you have any doubts, then overall I'm going to calculate NPV. Okay, is it completed? Yes, fine. Now let's calculate the present value. This is anyway today value only. So present value is minus 11.7, no change. For 4.2, I'll multiply it by annuity factor. And what annuity factor I have to take? I told you I should take the discounting rate. As 10% after tax, 10% after tax into 30%. So 10% multiplied by 1 minus 0.3, discounting rate will be 7%. So annuity factor 7% for a period of 6 years. So please calculate the annuity factor. 1 divided by 1.07 equal to 6 times, and then press GT. How much you get? Is it like 4? If I take 4 decimals, is it like 4.7665? Right, 4.7665. So multiplied by 4.7665. So this will give me 4.2 into 4.7665, 20.0193. And this also I multiplied by same annuity factor because interest will be annual cash flow. This amortization also is a matter of annual cash flow. So multiplied by same thing, 4.7665 minus 0.7149 minus 0.7150 minus 0.7150. And last year, nothing is there, but if we are to apply, that will be discounting factor. Huh? Nothing is there, but just for your reference. So what is NPV? Initial cash flow minus 11.7, annual 0.0193 minus 0.7150 minus 11.7. I think you get 7.6043. So NPV is positive. NPV is more than 0. So you can say that replacement is beneficial. Replacement is beneficial. So this is a problem on bond replacement decision. Okay, fine. So hope we got it. Let us move forward. Amal Limited has been maintaining growth rate of 12% in dividends. The company has paid 3 per share, has paid. So should I take it as D0 or D1? It is D0, dividend just paid. If it is dividend expected to be paid, then D1. If they just told dividend per share, you can assume anyways. Rate of return on a market portfolio like Nifty Sensex. For US, it is S&P 500 or Nasdaq or a Dow Jones. Market represented by an index, 15% RM. Risk-free rate of return in the market has been 10% RF. Beta coefficient of the company 1.2. You require to calculate expected return on company share as per CAPM model and the equilibrium price per share by dividend growth model. So let me apply the formula for CAPM and let me give you the uh, graphical presentation also on that. Okay, so as per CAPM, expected return is given by risk-free return plus RM minus RF multiplied by beta. What is the logical aspect? First of all, any asset class should provide minimum risk-free returns. See, if I'm investing in Infosys shares, if it gives me 3% per annum, what will I say? Why should I invest in Infosys and take so much of risk? I'll put in FD, easily I get 5-6%. So minimum I should get risk-free return. Then, because I'm investing in Infosys equity, I'm taking risk, I need to get more returns. I invest in Infosys, I invest in Adani. Both are equity stocks. So can I say, oh, both should give me similar extra return? No, it should give me different because Adani stocks are more riskier. They respond too quickly. I need to get compensated for that. That is what is measured by beta. So risk-free return is 10%. RM minus RF. Market is giving me 15%. If I invest in an index fund or a ETF representing Nifty, I'll get 15%. That means market is giving me 5% extra. That is called as market premium. Sometimes in the exam question, they'll give you market premium. It is already subtracted with RF. Market risk premium means 15 minus 10, 5%. But this 5% is for market risk. Market risk, remember, beta of market is 1. But this stock is having beta of 1.2. You are riskier 1.2 times. So your risk premium also should be 1.2 times of market. So 10 plus 5 into 1.26. Therefore, you should get 16% return. If I plot this in a graph, that becomes security market line. So x-axis is risk, which I measure it as beta. Y-axis is return, means return only, expected return. And this is zero risk. So the starting point is RF. When beta is equal to 1, market risk, what you get is market return, RM. But you are taking more risk than market, that is beta equals 1.2. So what you get here, corresponding thing is called as return of portfolio. That is expected return. Actual return may be more. That is what you are expecting may be more, and that is called as Jensen's alpha. But expected return is 16%. That is a representation in security market line. And they've also asked calculate the equilibrium price. They call equilibrium price intrinsic value, theoretical price, value per share, all are same. So value per share means what is supposed to be the value, intrinsic value, or they can call it as equilibrium price. Usually we apply Gordon growth model, which is D0 into 1 plus G divided by KE minus G. D0 dividend just paid, and that is 3 rupees, growth rate 12%. So 3 into 1 plus 0.12 divided by KE, what we just calculated, that is 16%, 0.16 minus 0.12. So 3 into 1.12 divided by 0.04. 84 rupees. So according to this theory, market price should be 84. But if the actual price is 85, just situational one, we say it is overpriced, and that's the time to sell. So this is act like a benchmark. If market price is more, that is overpriced. If market price is less, that is underpriced. Okay, let's go further. Let us take up this problem. A Limited has expected return of 22% and standard deviation of 40%. B Limited has expected return of 24% and standard deviation of 38%. So they have given the return also, standard deviation also, and A Limited has a beta of 0.86, B Limited has a beta of 1.24. They have given beta also. Correlation coefficient between A and B is 0.72. Standard deviation of the market is 20%. So they have given the market risk also. Suggest, is investing in B Limited better than A Limited? If your investment is 30% in B Limited and 70% in A Limited, what is your expected return and the portfolio standard deviation? Can you tell me which one are you going to apply? When I talk about portfolio standard deviation, I will always apply Markowitz. What is market portfolio expected rate of return and how much is risk-free rate? What is beta of portfolio if A Limited weight is 70% and B Limited weight is 30%? Okay, now let's compare the first one about A Limited and B Limited. They have given standard deviation, they have given the returns, that is X bar, and they've also given beta for A Limited and for B Limited. For A Limited, the expect return that, or you can say ER, expected return, nothing but average, 22. Standard deviation is 40. The return of B is 24. Standard deviation of 38. And A has a beta of 0.86. B has a beta of 1.24. Correlation coefficient, I'll write in between the two, 0.72. Okay. Is investing in B Limited better than A Limited? So standard deviation point of view, risk wise, who is lower? B Limited is lower risk. Now return point of view, who is giving higher returns? I think B is only giving higher returns. So B is giving higher returns also and low risk also. Definitely investing in B Limited is better than A Limited. You can write that conclusion. Investing in B Limited is better than A Limited. So investing in B Limited is better than A Limited. Okay, second one. If you invest 30% in B, 17% A, what is the expected return of portfolio and standard deviation? So second part of the question, portfolio return. So 30%, 70%, 30% in B. So 24 into 30% plus 22 into 70%. Please remember, they have given B first, then A. So read the numbers accordingly. So 24 into 0.3 plus 22 into 0.7. So I think you get 22.6 portfolio return. And the standard deviation of portfolio, Markowitz, you have to apply that A plus B whole square formula. Sigma 1 W1 plus sigma 2 W2 plus 2 sigma 1 sigma 2 W1 W2 and then multiplied by R. So in this case, sigma 1, I'll take it as A, which is 40. And in A, we are investing 70%. So 0.7 plus sigma 2, I'll take it as B. Standard deviation is 38. And weight is 0.3, 30%. Plus 2 sigma 1 sigma 2. So 2 into 40 into 30 into weights, that is zero point 0.7, sorry, yeah, anything does not matter, into 0.3 into 0.7 and multiplied by correlation coefficient, which is given as 0.72. Multiply all of them and add it, take a square root. You can use m plus function, MRC function, for simplification purpose. So clear calculator memory. 40 into 0.7 equal to m plus 38 into 0.3 equal to m plus 2 into 40 into 30 into 0.3 into 0.7 into 0.72 equal to m plus MRC square roots. So how much you get? Sorry, I should do square, no? Sorry, I'm completely sorry. I forgot to do square. I'm sorry. Sigma 1 square, W1 square, sigma 2 square, W2 square. I'm sorry. So it is 40 square, zero point 0.7 square, 38 square, zero point 0.3 square. I forgot. You also not reminded me. So please do the square. Please do the calculation once more. Okay. You see, mistakes happen. Ideally, in class, mistakes should not happen. I always say, class is like film theater. You go to class and enjoy somebody else's performance like movie. You don't have any obligation, responsibility. Examination is like a operation theater. Surgeon called as institute, anesthesia called as question paper. You don't feel the pain in exam hall. Once you come out of the exam hall, you start discussing with your friends. Anesthesia comes down and you start feeling the pain. After 2 months, result comes, operation success, patient died. Anyway, I mean, you pass all the exam, but still overall aggregate is a problem. So please square it once more and let me do it also. 40 square. So 40 into 40 into 0.7 into 0.7 equal to m plus 38 into 38 into 0.3 into zero point 0.3 equal to m plus 2 into 40 into 30 into 0.3 into 0.7 into 0.72 equal to m plus MRC square root. 35 something you get. 37, no? Something. This is 38 and not 30. Okay, this is 38. I wrote 30, for example, side deviation I wrote as 38. Here, let me 30, please correct it, it's 38. I think you should get 37 something. That 37.06, right? Yeah. Yeah, I've corrected. 2 into 40 into 38. I've corrected. So approximately you should get as 37.06, 37. Let's say approximately. Okay, that is what second part of the question. What is the market portfolio expected return? How much is risk-free rate? So in that case, what we're going to do, I hope you got that number, that is 7.06. We have return of stock A and we have return of stock B, and we are trying to solve simultaneous equations, and we are going to get the missing figures. Let me do it for you. You also do it together. So what we have, return of stock A, return of stock B, that is RF. If I use the formula, RF plus RM minus RF multiplied by beta. Risk-free rate, I don't know. I'll call it as RF. Market return, I don't know. I'll call it as RM minus risk-free rate multiplied by beta of stock A, we know 0.86. And return of stock A is given to be 22%. Similarly for B, RF, I don't know. RM minus RF, we'll take it like this, into beta. Beta is 1.24 and difference, I mean the return is 24. So you have a case of simultaneous equations. So find out the difference. So 22 minus 24, you get minus 2. And when I do minus and minus, RF gets cancelled. RM minus RF, I can take it as common. And I get 0.86 minus 1.24. Okay, let me solve and then I'll give you one more shortcut formula. So RM minus RF, you get minus 2 divided by 0.86 minus 1.24. So minus 2 by 0.86 minus 1.24 minus 0.38. 2 by 0.38, you get 5.26 something. 5.26. In fact, you can understand logically, my dear friends, what is essentially the uh, amount represents. Incremental return is attributable to incremental beta. Anyway, let's just do this one. Let's not confuse. Solve the equations. We got RM as RM minus RF as 5.26. Substitute in one of the equations. Substituting this RM minus RF in first equation, for example, the return of A, RM minus RF is 5.26. I mean RF plus RM minus RF 5.26 multiplied by 0.86. This is 22. Simplify. RF equals 22. This becomes minus 5.26 into 0.86. 22 minus 5.26 into 0.86, 4.52. And 22 minus 4.52, 17.48. So this is RF. So what is RM then? RM minus RF is 5.26. RF is 17.48. So what is RM equals 5.26 plus 17.48. Just 1 second. So 22.74. Okay. Last part of the question. What is the beta of the portfolio if 70-30% is there? Just compute the portfolio beta, last part. That is 0.86 multiplied by I think 30% plus 1.24 multiplied by 70%. 0.86 into 30%, 1.24 into 70%. 0.86. 0.86 is, oh, A is 70, B is 30. Yeah, okay. Sorry. A is 70 and B is 30. Yeah, see, this is what happens sometime opposite. 0.86 into 0.7. 1.24 into 0.974. Yeah, 0.97. Yeah, that's portfolio beta, what they've asked. Great. Okay, that's about this problem. I hope you are able to get it. On 1/4/2012, ABC Limited issued 20 lakh units at rupees 10 per unit. Relevant initial expenses involved were 12 lakh. It invested the fund so raised in the capital market instruments to build a portfolio of 185 lakhs. So please follow this sequence of events. You have issued 20 lakh units at 10 per unit, so the fund would have received 200 lakhs. Issue expenses were 12 lakhs, so out of 200, 12 will go for issue expenses. Then they built a portfolio of 185 lakhs, therefore you subtract 185. In the sense, these are all the outflows. And 185, of course, will be called as investments. During the month of April 2012, it disposed of some instrument costing 60 lakhs for 63 lakhs. So you sold for 63 lakhs and used the purchasing the securities for 56 lakhs. Again, you purchased 56 lakhs. Fund management expenses for the month of April was 8 lakhs, of which 10% was in arrears. So out of 8 lakh, 10% is outstanding, so 80,000. Balance 7 lakh 20 would have paid in cash. In April 2012, the fund earned the dividends amounting to 2 lakhs and distributed 80% of the realized earnings. On 30th April, market value of the portfolio 198 lakhs. Mr. Akash, an investor, subscribed to 100 units on 1/4/2012 and disposed of the same at closing NAV on 30th of April. What is his annual rate of earnings? This is a typical problem that you can expect in NAV calculation. So what is NAV? Net asset value per unit is calculated as market value of assets minus liabilities divided by number of units. And in this problem, what is the assets we are having? One is definitely the investment in market, that is investment in shares or market value of the portfolio. Second one is the cash held. Now for the cash held, they are not giving you the amount directly. We are to follow the series of transactions, which is what I was just explaining. So for cash held purpose, it requires some calculations. So 20 lakhs into 10. So 200 is the amount received. 12 lakh goes for issue expenses. You subtract and you invest 185. that is also going out. Cash flow will come down. And the instrument costing 60 lakhs, sold for 63, you focus only on cash portion. So you have sold for 63, that is what the money you receive, and you purchase 56, that means to that extent cash will go out. Then fund management expense is 8 lakhs, but you're not paying entirely 8 lakhs. 10% is in arrears. 10% means zero point 0.8. So what you pay is only 7.2 effectively. Then they distributed, they've earned dividend of 2 lakhs. Dividend they earned plus 2 lakhs. And next point is interesting. 80% of the realized earnings. What is realized earnings? Two kinds of realized earnings. One, dividend. So the dividend to 80%, dividend they receive 2 lakh, 80% they pay out. And they've also made profit on sale. What is the profit on sale? Costing 60 lakh, sold for 63 lakhs. And therefore, that 3 lakhs profit you get, on that also 80% distributed. So this will give you the cash balance. And then we add the market value of the portfolio, which they have given directly, so no need to worry about it. Sometimes they don't give this value directly. We have to calculate based on the index movement. They will tell you when the investment was made, index value was 1000, and on the current date, the index value became 1500. So you assume the portfolio also moving in the same proportion, 1500 divided by 1000 multiplied by whatever is the investment value. If they don't give the portfolio like that, from exam point of view, we may have to calculate like that. Anyway, so let's calculate these things, and this is what the cash plus the market value portfolio minus liability. What is that liability? That 0.8 is spending, payable to the management expenses. Asset minus liability, you get net assets, divided by number of units, you get NAV. So let me do that. So initial amount received, 200 minus 185 minus 12. You received 200, that is 20 into 10. 12 has gone for fund issue expenses. 185 is reinvested. Sale of securities 63 received. Purchased 56. Dividend received 20. Fund management expenses 10% outstanding. That is 8 minus 0.8 I told you. So what is cash paid is 7.2. Dividend distributed, realized earnings. So this dividend received to 80% distributed. Capital gain, that is 63 minus 60, that was the capital gain, and 80% is distributed, so 2.4. So cash balance coming to 0.8. Market value of portfolio they have given 198. So total 198.8 minus liabilities, the arrear of expenses, that 10%, that is arrears expenses. So net asset is 198 divided by number of units, that will give you NAV per unit. And what they are asking for is the return for the investor. That is, you calculate like P1 minus P0 by P0 into 100. So return for investor. Closing NAV 9.9. Opening NAV issue price 10 divided by opening 10 into 100. This will give you in percentage terms. Plus, sorry, not plus. This is for a one month holding period. So you multiplied by, this is for 1 month. How much for 12? You have to annualize it. So divided by 1 multiplied by 12. So this will give you percentage in annual terms. I think he has lost minus 12% per annum. But please remember, this is only considering NAV, and they've also received dividend. If you consider along with the dividend, the answer will be slightly different. So if you consider with the dividend, this is without a dividend. This is purely price returns. If it is with dividend, what you're going to do? How much dividend per unit? You received total distributed 2.6, I mean 2.4 and 1.6. 4 divided by 10. I think zero point 0.4 per unit is paid as dividend. So 9.9 minus 10 plus 0.4 divided by 10 into 100 into 12 by 1. 9.9 minus 10 plus 0.4 divided by 100, so divided by 10 into 100 into 12. 9.9 minus 10 plus 0.4 divided by 10 into 100 into 12. So you get, what is that? How much you're getting? 9.9 minus 10 plus 0.4 divided by 10 into 100 into 12. 36. Huh? Okay. If you consider dividend, you get 36% per annum. Maybe you can take screenshot of this and you can.
Sir, 4 lakhs for 2 lakh, 20 lakh units, right?
20 lakh units. So sorry, that 20 lakh units, correct. You are right. That's just wondering how big number. Thank you for correcting. So 4 divided by 20. So you get zero point 0.2, I think.
Yes, sir. Point two.
So 9.9 minus 10 plus zero point 0.2 by 10 into 100 into 12. Yeah, you get 12 plus 12% per annum. You get that. Yeah, plus 12. So the previous one was without dividend, and this is with dividend. In the exam, even if you show with dividend, one is fine, but if possible, you can show both.
गलत है या फिर ये क्वेश्चन में उन्होंने मिस्टेक करके रखा हुआ ये 3 मंथ होना चाहिए। तो मेरा काम है बताना, मैंने आपको बता दिया, तो मैं 3.7% के हिसाब से ही सॉल्यूशन करूंगा। तो यहाँ पर अगर हम निकाल
Okay, fine. So if you have written down good, if not, if you have taken a screenshot, that is also fine. Let us go further. Mr. Dayal is interested in purchasing the equity share of ABC Limited, which are currently selling at 600 each, current market price. He expects the price of the share may go up to 780 or may go down to 480 in 3 months. He's looking at only two possibility. This is called as binomial model possibility. Either goes up or come down. Only two possibilities. The changes of occurring such variations are 60% and 40% respectively. A call option of the share can be exercised at the end of 3 months at a strike price of 630. So holding period 3 months, exercise period, exercise price, strike price 630. What combination of share and option should Mr. Dayal select if he wants a perfect hedge? That is option hedging basically. What should be the value of the option today? Risk-free rate is 10%. What is the expected rate of return on the option? So when it comes to binomial model, Only two possibilities you can see, either 780, 480. So binomial model, there are two approaches in which you get the same answer. One approach is called as portfolio replication model, other is called as binomial tree model. Now, let me show you the solution both ways, and I'll also cover the concepts. So what are the terminology what we have now, information what we have now? Spot price today, it is currently selling at 600, and after 3 months it might become 780, or it might become 480. So price increases, you make profits. Price decrease, you will make loss. Now this is what the possibility exists. Now when you want to do a perfect hedge, so what do? Along with the spot price, you also include an option. And in this case, we are talking about a call option. Now, in call option, what will holder do and what will writer do? Holder will buy the shares, correct? Now, in the spot market, you are already bought the shares. That is a basic premise. If you have already bought the shares in spot market, in option also if you buy, where is the risk you are trying to reduce? So option you would like to sell. Therefore, in option market, you become call option writer. And of course, you receive premium. So in spot market, you buy the share. In option market, you sell, that is, you become a call option writer, and 1 plus 1 minus, 1 long, 1 short, you try to manage your risk. You try to hedge your risk. Okay, now after 3 months, what would happen? I mean, you are a call option writer, but what would holder do? Let's take after 3 months, the strike price is given as 630. Now, do you think the option will be exercised? After 3 months, if market price 780, market price is more, yes, call option exercised. So intrinsic value 780 minus 630, 150, option exercised, not by you, other person, the holder. Option exercised. If it becomes 630, I mean, if it is 480, or then market price is less, in that case, it is zero, option not exercised, option lapse. Okay, now what they're asking is what combination of share and option you should select so that you achieve a perfect hedge. So create a portfolio or create a combination of shares, I mean portfolio and options. And that is, you take a portfolio. Okay. Create a combination of shares and options to create perfect hedge. To create perfect hedge. And there, the question is in which ratio I have to mix. Is it one share, one option? For that, we call it as delta. It's also called as hedge ratio. There is a derivation for this formula. Let me not worry about it. Let me give a very simple one. This is called as C1 minus C2 divided by S1 minus S2. C1 minus C2 basically represents the difference in intrinsic value. You can say the spread in intrinsic value. Why is called a C1? Because I'm doing for call option. So spread in intrinsic value divided by spread. S1, S2 means whatever is the spot price on expiry date. Spread in market price. Now, what is the intrinsic value? One is 150, other is 0. So 150 minus 0 divided by spread in market price, that is 780 minus 480. That is 150 divided by 300. So you get 0.5. And what is the meaning of delta of 0.5? Having the share and the option, the ratio should be 1 and zero point 0.5. That is, if you have one share, that is equal to 0.5 options. So risk of one share is equal to the risk of 0.5 call options. I cannot have 0.5 call option. So if I want to make it comparable, then I should do into 2. I mean, one share is 0.5. If I want one call option, then how many share I need to have? I mean, that is only a comparison purpose. Anyway, write down till here. So basically what this means, your portfolio becomes risk free if today you take a shares long position and options short position. Whatever happens after 3 months, your portfolio is protected if you maintain this ratio. See, first of all, I'm trying to give you detailed conceptual understanding, and then I'll give a quick step what you can adopt in examination. You can write faster. I hope you've written till here. Yes. Okay. Now, so as usual, my method of explanation will be there. So today the position and after 3 months. So what is the position today? You're having shares position and you're having one share, and that is equal into zero point 0.5 call option. That is the ratio in which you're taking position. One share, that is you're taking long, that is you hold, and one call option, you become a writer. And after 3 months, the market price can be either equal to 780 or market price can either be equal to 480. Two situations they are discussing. Okay, sorry, I just explained one thing slightly wrongly. Let me correct it. It is risk of one option is risk of zero point 0.5 shares. I think I slightly explained you interchangeably. I'm sorry for it. Risk of one option is equal to risk of zero point 0.5 shares. So when I say delta of 0.5, it's called as fractional shares. You remember like that. It is called as the fractional shares because we're calculating the value of one call option. So one call option is equal to zero point 0.5 shares. So you're having a zero point 0.5 shares long position is same as one call option writer. I'm sorry for it. Just interchange it. Okay, now. And what is the value now? Current value, current position, current market price is 600. So if I do 600 into zero point 0.5, this is 300. And when you're a call option writer, you receive premium. So I'll just call it as VC, value of call. You receive premium. And net portfolio value, I will write it as 300 minus VC. Why I write as 300 minus VC? So 300, I'm taking long position is like my asset. I'm paying 300. And writer, I'm taking a short position. Therefore, the premium amount I receive. So 600, 300 rupees I pay and value of call option receive. So net payment, net investment you can see. That amount I don't know. That's what you have to calculate. Now, if the market price becomes 780, what will happen to your position? You're having 0.5 shares. Its value will be 780 into 0.5. So that becomes 390. And what will happen to the call option position? You're a writer. Market price is high. Call option exercised. You're a writer. So you have to pay the intrinsic value. So 780 minus strike price of 630 means 150 rupees. This is the income for the holder. But for the writer, you're a writer, so you lose 150. So your value will be 240. Or if it becomes 480 rupees, then 480 into zero point 0.5, this becomes 240. And when market price is less, it is not exercised, so it becomes 240. So you see, if the market price is high also, 240 rupees will be the portfolio value. If the market price is less also, to portfolio value will be 240. That is what is perfect hedging. And if that has to happen, what is the amount today? Of course, you should adjust for the rate of interest divided by 1 plus R, the present value of money. So today portfolio should be present value of future portfolio. So 300 minus value of call, or if I multiply, if I compound it, this is present value spot today multiplied by 1 plus R to the power of n, whatever the time period, I should get the future value of 240. And 300 minus value of call is what I would like to calculate, multiplied by 1 plus rate of interest, risk-free rate 10% per annum, and this is for 3 months. So I will take it as 10% for 3 months. Again, to the power of n not required. I'll just take directly 10% for 3 months, 0.025 I get. I did not understand the 3 months later calculation. I mean, 3 months later, the situation concept or the calculation part, like how this 240 came. Is that your question? Or what is the position? That is what you're asking. Okay, good. What is that we are trying to build it today? I'm having the shares and I'm also having the option. Shares and options. In shares, I have taken long position, and in option, I have taken short position. I have done a perfect hedging. And perfect hedging, I have to maintain a certain ratio. That is why I calculated delta. And the ratio is 0.5 shares and for one call option. So what is the value of portfolio today? I have 0.5 shares and one call option. So 600 into 0.5, that becomes 300, and one option, and that is, I don't know the value, I've kept PC as it is. After 3 months, in shares, I'm a holder, I'm investor. In option, I'm a writer. So what is my position in these two cases and what is my net impact? After 3 months, if the market price is 780, what will happen to my spot market? I had one share, so I had 0.5 shares. So 0.5 share means the portfolio value will become 390. And what will happen to the call option? Market price is 780, strike price 630, market price is more, option exercised. And intrinsic value becomes market price minus strike price, 780 minus 630, 150. That is a profit for the
So,
holder, but we are a writer, so you get loss.
so sir,
Yes, got
after three months, when the market price is 780,
780.
we in the long position we will sell and we
And
will
then you
earn
will sell, you'll receive 390. You can say that. You receive
390,
390. Yeah.
and then option the holder will exercise, so I will lose 150.
Yes, as a writer, you have to pay 150, so you lose 150. Correct.
Okay, that understood. Then when the market price is 140,
480.
480.
When the market price 480, the shares you understand 240 because you have half shares.
Sir, I will
No, that is,
um
on the shares you understood.
when
The 240 is fine.
no
240
sir,
is, yeah, tell me.
I will still sell it, is it?
Yeah, I still sell it. But what I'm trying to tell is whether the market price goes up or market price comes down, my portfolio value should be same. And that's what happening
Okay.
here also. So, and that's how that 0.5 was determined. The derivation of the formula, if I go. So I have 0.5 shares today. And after 3 months, if it is 480 rupees, its value become 240. That is my portfolio value on shares. Whether I sell it or I still hold it. That is the value on that date.
Okay,
If I sell, I receive 240.
but we will not try to find the profit or loss that we've earned
So that is one
by
method.
holding a long position.
No, you can calculate the profit or loss. But what I did in the first case, I'm not calculated the profit. I just calculated how much amount of the portfolio I will have. I can also go by profit or loss method. If I go by profit or loss, then I should look at only the profit amount, 10% that profit they're telling, risk-free return. I should only compare that. So I'm not going by that method. I'm not calculating profit or loss. I'm calculating portfolio value today and portfolio value after 3 months. The portfolio
Okay.
value should not change except for time value of money.
Okay, sir.
Yeah. So the again, I'll just read the sentence. Create a combination of shares and portfolio to create a perfect hedge. Perfect hedge means today portfolio value is same as after 3 months portfolio value adjusted for time value of money. Yeah. So in the second case, it's zero option. So we get 240. So whether you get this 240, 240, portfolio after 3 months is 240 in both the cases. So today portfolio is 300. You adjust for value of call, and that should be equal to 240. We just have to adjust for time value of money. So I multiplied by 1 plus R. 10% per annum. For 3 months, I took 2.5%, 10% by 4, just proportionately for 3 by 12. And that should be 240. You simplify. So I'll take this to right side. So 300 minus value of call is 240 by 1.025. So value of call, you can simplify 240 by 1.025 and minus 300, you get 65.85. So what does this means? If you receive the premium worth 65.85, whether the market price goes up or market price comes down, your portfolio value will not change if this is the amount of premium. So that's what they asked. What is the combination of share? And that's what we calculated. The combination of share is 0.5. That is, one option is 0.5 shares. And what is the value of the option? The value of option should be 65.85. Okay. Now, as far as examination point is concerned, VC is in present value terms. Yes, it is already in present value. So it is premium. This is, I can say, theoretical option premium value today. This is supposed to be the option premium value. If actual option premium is more or less, there exists arbitrage opportunity. Okay, this is the whole set of conceptual calculations concerned, today value, tomorrow value and all. Now what to present in exam, I'll quickly show it in 2 minutes. So you observed here, we have to calculate delta value and then we have to calculate the portfolio value. Either if market price goes up or market price comes down, both are equal. So any one of them you can take. So I will take the easier one when the market price is down because the option is not exercised. So I'll take that as the base and give you the steps for solving in examination. So before that, you write down till here and ensure conceptually you are fine.
Sir, I have a doubt.
Yes.
So when we read it when the 600, we read it as the value of share today.
600 is the share today.
So when they're asking the second question, value of option today, so we might think that it is the rupee value of the option today. No,
Rupee value of option, that is
but
65.85.
then it is premium that we've calculated. Is there a difference between premium of the option or the option value itself?
Same. The what is that amount that we have written as VC? This is the amount of option that you should receive so that the value of portfolio is steady. And that amount is also called as premium. So as
But
a
it's not
right,
that strike price, no, sir.
that
When
is
they
not
say
strike
what
price.
is,
No, the option value is not strike price. Strike price is this 630.
okay, sir.
So the option value is nothing but the premium. Only thing why I call it as option value because it is theoretical premium. Actual premium is again determined by market factors, but supposed to be approximately this. But conceptually, you can keep it like this: option premium and VC value of call, both are same.
Thank you, sir.
Okay. So this is as far as the conceptual steps are concerned. For solving problem in exam, I will follow simple step like this. So first question they asked, what is the combination of shares? So for the combination, I need to calculate delta of call option. Delta of call is calculated as C1 minus C2 divided by S1 minus S2, meaning difference in call option by difference in spot price. Now, what is C1 minus C2? That is when the market price happens to be 780, strike price is 630, market price minus uh, strike price. So 780 minus 630. This is C1 minus C2. If the market price is 480, market price is less, call option not exercised, 0, divided by S1 minus S2. So the market price in the first situation is 680, second situation is 480. So you get 150 by 300. So that ratio is 0.5. You got the delta. Second thing, they're asking what should be the value of option, nothing but theoretical option premium. The value of call option can be calculated as simple formula like this. Today portfolio minus present value of the portfolio, a future portfolio at lower price. I can take higher price also, lower price also. Higher price means I have to adjust for premium and all, some more calculations will come. But you know, I just now proved it, lower price, higher price, both will be equal. So it's faster to calculate present value of future portfolio at lower price. Today portfolio, please take for fractional shares. Today market price 600 and fractional share nothing but delta. Okay, I'll write the formula for you. The current market price multiplied by delta. This is the today portfolio minus present value of future portfolio when the price is down. So delta of call option is the ratio multiplied by lower price means L, and I need present value by simply divide by 1 plus R. That's all the formula I should remember. Today portfolio minus present value of future portfolio at lower price. This much I think you should remember. Current market price is 600. Delta is 0.5. Then delta is 0.5. Lower price is 480. Divided by 1 plus R. Rate of interest 10% for 3 months. So I get 0.025. So 600 into 0.5 means 300. And the 0.5 into 480 by 1.025, that is 234.1. So 300 minus 234, you get 65.85, 8685, whatever it is. So examination, first and second question, you write this much, sufficient. If any beta is given, this will change. No, this is beta is relevant for if you take a position in futures. So you can remember like this, for future beta is used, for options delta is used. So for option hedging, beta will not be relevant.
So this is value of call. So value of put option,
Will
that
be one minus of this basically.
okay.
If they ask
And
value of put, it will be one minus because put is always in opposite direction. So if you want, you can just write for your reference delta of put if they ask. But I have not seen it so far in exam. You can simply do one minus of delta of call, just the opposite.
so the present value of future portfolio at lower price. So where we have to take that option, that scenario where the put option, the
Call
option is
option
not
will
exercised.
not exercise, so that number will not affect our calculations.
Calculation. Okay, sir.
It is just a simple option we have used.
Okay, sir.
Okay. One more thing what they've asked is what is the expected rate of return? I'll simply write it here itself. So expected rate of return by applying the probability. That is, they have given the probability that the chances are 60% and 40%. So if you invest 65.85 today, what is likely to be the value when you exit? In the sense, this is the premium today. What is likely to be the intrinsic value on maturity? If it is 60% probability, 40% probability, intrinsic value is 150 or 0. And 150 probability is 60%, 0 probability is 40%. So you can calculate the expected value by using probability. Anyway, I'll do it. I hope you have written till here. Shall I take this out? Yes, okay. So I'll just write it here itself. So I can't do Control Z. Okay. Third one. On expiry, I mean after 3 months, if market price is 780, then intrinsic value is 600. If market price is 480, intrinsic value is 0. And what are its probability? This probability is a 60%. And this probability is 40%.
Sir, intrinsic value 150.
150 you get. Okay, strike price is 600. Correct. So 780 minus 600, intrinsic value becomes 1. So either intrinsic value is 150 or 0. Chance of 60% is 150 and 0 chances is 40%. So what is the expected value? This is 150 into 60% plus 0 into 40%. I think you get expected value of 90. So today if you invest, premium is 65.85 and after 3 months it becomes 90. That means today you buy at 65.85, after 3 months you receive 90 rupees. So what is the rate of return? So rate of return 90 minus 65.85 divided by 65.85 into 100. And if you want to express per annum basis, then you multiply it by into 100 divided by, I think, 3 months holding period. I mean, if I just calculate this number, 90 minus 65.85 divided by 65.85 into 100, you get 36.67% return. If, of course, things goes as per expectation, expected return, I would say.
So
Yes,
call premium is our expense.
correct. Is our investment. You can say expense or is like investment. Investment today. And 90 rupees your income. I mean, is your intrinsic value.
No, sir, we are the call writer, so that is our income,
I
right?
mean, this is the rate of return is like is calculated from holder's point of view.
Okay,
Because only
okay.
holder will make the profit. Yeah, I think I should be specifying. You can write it from holder point of view. This is not from writer point. For holder, the premium is the expense and intrinsic value is the income.
So
Yes,
this when we say return, shouldn't be the payoff is equals to return?
it is payoff, but in percentage terms. The payoff, and so in this case, payoff is not the payoff 150 is 0 alone, considering the probability, because two possibilities are there. It can be 780 or it can be 480. So considering both of the probabilities, the expected value, expected intrinsic value happened to be 90 and premium is 65. So premium and intrinsic value, the difference is the payoff. That is the profit you're getting for an investment of 65 rupees. So today value
But this is
65.
not.
Yes.
But this is not our profit, no, sir.
No,
It
this
is
is
for the whole.
no, this is I'm calculating from the instrument point of view. So to calculate the delta, we have assumed the hypothetical portfolio that a combination of one share and an option. But what rate of return I'm trying to calculate is from the holder point of view. From the writer point of view, I cannot calculate like this. I'll tell you why. Writer, what amount he invests, you tell me. Writer don't invest anything, right? If you think purely from option point of view.
Yes,
But
sir.
but he will have to pay something called as margin money. Just like futures, future by future will pay margin, even option writer will have to pay margin. That is his investment, and return what he gets at the end is his profit. So that should be the way for you to calculate rate of return for writer. So in the exam, if they ask you, calculate the rate of return from option, they just ask, you calculate from holder point because
Okay.
instrument is valued based on the holder point for that reason. Okay, now this we have understood using binomial model, considering this is called as portfolio replication approach. And whenever they ask you what combination of share options should they do, or if you talk about option hedging, you have to calculate delta, you should remember this formula. There is also one more method in which you can arrive at the same value of call option. That is called as binomial tree method. And that is required if we have to solve two-period binomial model. So let me explain that concept. And that is definitely more logical. And I'll give you quick the steps in exam also, what you should approach. Okay, so binomial tree option, or it's also called as risk neutrality method. Risk neutral method. Okay, see, today you have a spot price, and after 3 months, the price can be either it can go up to 780 or it can come down to 480. Okay, now how do we convert these two numbers into single number now? Today price is 600. This is the today value. The future value, I will have to apply probability like I did for intrinsic value. Probability, I mean the price multiplied by probability, another price multiplied by its probability. Now for the time being, I take the probability as P. I know in the question they said 60%, 40%. I'll keep that aside. If the probability of price going up is P, the probability of price going down is 1 minus P. Probability of price going up and probability of price coming down. Then what is the expected price? 780, its probability is P, plus 480, its probability is 1 minus P. And this is the future price. If I discount at risk-free rate, what is the probability I get is called as risk neutral probability. Probability is such a way that investing in the share will give me the same expected return as if I invest in risk-free asset. That is called as risk neutral probability. It is probability such a way that return of share and the return of risk-free asset are same. It's like a benchmark I'm trying to calculate. What should be the probability of the share so that the return expected in the spot market and risk-free return both are equal. So, and rate of return is what? Rate of return is in this case 10%. So for 3 months means 0.025. So if I equate this 600 into 1.025, you simplify this 780 into P, 780P plus 480 into 1, 480 minus 480 into P, 480P. So 600 into 1.025, 615 minus 480 equals 780 minus 480P, 300. So P equals 615 minus 480, 135 divided by 300, 0.45. That means if the probability of going up is 45%, if the probability of the share going up is 45%, then the return expected from the share and from the risk-free asset both are equal. If the probability is more, you are likely to get more return. If the probability is less, then you better go to the risk-free asset that only is expected to give a higher return. Anyway, so that's always the step to calculate using the binomial risk neutrality method. But instead of calculating these long steps, there is one shortcut formula which Institute also definitely accepts. The probability is given by, risk neutral probability is given by R minus D divided by U minus D. R is nothing but 1 plus risk-free rate. U is 1 plus percentage up. D is 1 minus percentage down. In this problem, what is R? Rate of return 1 plus 10% for full year. So I take 0.025 for 3 months. So 1 plus R is 1.025. 1 plus percentage up. How much percentage is up? I mean, ratio up. 600 become 680. So what is the ratio? 780 divided by 600. I can just simply calculate like that. The ratio is that 780 by 600. 1.3. That is basically 30% up. Percentage down, it can come down to 480. So 480 by 600, I think you get 0.8. So R minus D, that is 1.025 minus 0.8 divided by U minus D, that is 1.3 minus 0.8. So 1.025 minus 0.8 is 0.225 and 1.3 minus 0.8 is 0.5 and 0.225 divided by 0.5 is 0.45. So you see same number we got. So if you're comfortable with the logical part, you go for logical part. Or if you're comfortable with the formula for probability, you compute the probability. This is risk neutral probability, not expected probability. Expected probability based on historical events. Like in the problem, they said 60-40. This is risk neutral probability, so that investing in risk free asset and investing in risky asset both are equal. What should be that chance? And once you calculate the probability, then the value of option is present value of expected intrinsic value. What could happen intrinsic value? You multiply it by the probability, the present value is option premium value. So I'll just take this part out. So in examination, even if you don't write all these big steps, that is fine. If you follow risk neutral method, you can simply apply this formula approach. This is the first step where you want to apply. Second step, you get the value of call option. The value of call option can be calculated as present value of expected intrinsic value. Basically, it means high price minus strike price. That is the intrinsic value if the market price goes up. Basically, C1 multiplied by probability. Plus, usually when the market price goes down, it will be 0. But still, if you write as a format, lower price minus strike price multiplied by 1 minus probability. This will be usually be 0. This is the expected intrinsic value divided by the present value, means 1 plus r or e to the power of rn if you're doing continuous compounding. In this example, if I apply high price 780, strike price 600, risk neutral probability, that is 0.45, plus when the market price is down, anyway that is 0, into that probability 0.55, 1 minus 0.45, divided by 1 plus r, so 1 plus 0.025. So this is 180 into 0.45 divided by 1.025. $79.02. 79. There's something wrong. What happened? 180 into 0.45 divided by 1.025. Oh, should be 65. No, where the calculation gone wrong? Give me 1 minute. It should be same answer.
Sir, not 600, sir, 630 strike price.
So 630 is the strike price. Okay. 630. So it's not 180, it is 150. Yeah, I think 150 we got it earlier also. C1, C2 when I calculated. 150 into 0.45 by 1.025. Yeah, 65.85. So even for put option, you can simply change. How can you do? Instead of high price minus strike price, you do strike price minus high price. When strike price minus market price, you get even for put option. But if they ask you in the examination, calculate based on the hedge ratio, option hedging, you can't do this risk neutral method. You have to follow the portfolio hedging method where delta is calculated. So in one method, we calculate delta. In other method, we calculate the risk neutral probability. You can use this formula to write the answer faster.
Sir, in the third part of the question, when we solved,
Yes.
the same thing we have done just with 60% and 40%, and we got 90 as expected value.
Yes, in the earlier part, we got 90 as the expected value,
Expected
and that is
value.
based on what probability?
Correct, and that is after 3 months.
This
So
is
if
after
we
3 months.
divide by, yeah, and we divide, if we divide by 1.025, we'll get the we should get the value of call, right?
No, we don't get it there. It's in the this question.
Yeah.
This is calculated using the probability of a 60% and 40%.
Uh-huh.
And this is not risk neutral probability.
Okay,
This is,
only in risk neutral probability, if
yeah,
we calculate, we'll get
correct.
value of call.
When you use the risk neutral probability and you calculate the expected value and you come to the present value, you get the value of call option.
Okay, sir. Thank you.
And that is what connecting the two methods. What is this method? We learned in perfect hedge. You remember this conceptual part in the perfect hedge? We compared, right? I think I erased it. Yeah. Anyway, I compared value of current portfolio and the future portfolio. The only thing which connecting is the 1 plus R. Or the formula part we did current portfolio minus present value of portfolio after 3 months. And the present value I have used risk-free return. And here
Yes.
also for present value purpose, I am using risk-free return. Using the risk-free return, I am calculating the probability. So basic assumption under risk neutral method and portfolio application approach is my return is just risk-free return. And if I ask you a question other way around, let me say, what is my intrinsic value? In this case, what is the expected intrinsic value? What I'm getting after 3 months? It is 115 to 0.45. How much you get that number? That is the expected intrinsic value.
67.5.
Yeah, 150 into 0.45, 67.5. Now this is the intrinsic value after 3 months. Today value is 65.85. If I follow the same approach like I did in the previous case, so what is the return I get like I did in the third part?
Yeah.
67.5 minus 65.85 divided by 65.85 into 100. You get 2.5%.
2.5.
That is for the risk-free return we have taken everywhere as 2.5, 3 months. Annually, it becomes 10%.
Okay. Okay, sir. Thank you.
If I have to explain in slightly different way, if the probability of price going up is the 45%, I will reach the risk-free return of 10%. If the probability is more than 45%, in the problem there's a 60%, definitely I'll achieve more return, and that happened to be some 36%.
Yes.
I hope the probability can be compared with what is supposed to be risk neutral and what is their observed probability based on historical returns. Okay. Okay, so let's move further. Next question. Ram buys 10,000 shares of X Limited at 22. No, not this one. And sells something. Sorry, not this problem. I think this one, right? Ram buys 10,000 shares of X Limited at a price of 22 per share, whose beta value is 1.5, and sells 5,000 shares of A Limited. What do you mean by selling? He's taking short position in A Limited at a price of 40 per share, having beta value of 2. So in one, you're having long, and another stock you're having short portfolio, long, short portfolio. He obtains a complete hedge by Nifty futures at 1,000 rupees each. See, they've told 1,000 rupee each, but how many units they've not given? So here we have to calculate number of units. He closes out his position at the closing price of next day when the share price of X Limited dropped by 2% and share of A Limited appreciated by 3% and Nifty future dropped by 1.5%. So first of all, you are having a portfolio with two components. There is X Limited and there is A Limited. So our first objective is to compute the portfolio beta value. So let's calculate the portfolio beta. Then we'll do it in a columnar format, stock, whatever the portfolio value. Let's just call it as value of investment or just a value. Then based on the value, we can calculate the weight and we'll multiply it by beta and we'll get the product. The stock, we have X Limited stock and A Limited stock. X Limited, we have 10,000 shares of 22 per shares, that is 2,20,000. A Limited, you are sold. So I'm going to write it as minus a short position, minus 5,000 into 40 per share, that is minus 2 lakh. Net amount 20,000. So what is the weight? Very interesting. The amount divided by total. Usually total is more, but here total is less. So 2,20,000 divided by 20,000. So weight what you get is 11, and minus 2 lakh divided by 20,000. So weight is minus 10. Total weight is 1, and that's always the case. And beta is 1.5 and minus 10, and that is beta becomes 2. So multiply 11 into 1.5, 16.5 minus 20. So please observe your beta is negative. So what is the position you have to take from the portfolio? You have to reach some target. What is your portfolio current portfolio is minus 3.5. This is the existing position, short position. But target is what? Complete hedge. Target means you want to reach 0. If minus 3.5 should become 0, so can you tell me then what should I do in future? I should do plus 3.5, right? Now plus 3.5 means in future I am going to take long position, and 3.5 to 20,000, that becomes effectively 70,000. I repeat this one. Please try to follow it carefully. I have a current position in portfolio and I have a target to achieve. Now, how do you reach the target? That you achieve through the route of index futures hedging. You are having, let's say, presently 1.2 and you want to make complete hedge. Complete hedge means 0. no risk, zero. So from 1.2, if you want to make it zero, minus 1.2 should be the position index future, and minus means short in index futures. Your present position is 1.2. You want to achieve a target of 1. Then what is the root? Minus zero point 0.2, and minus means short in index futures. So whenever you get a plus sign, it is long, minus sign, it is short. But what you should look at, what is the root? Sir, minus sign is there, sir, so I should take short position. No, minus is there in present position of portfolio, and you have to reach zero. So from minus to zero, you have to take the position of plus. In other words, your portfolio impact is minus. Your portfolio is indirectly short. And to make it into a zero, you should take a long. But anyway, instead of thinking long short, first try to think as minus and plus. What is my present position? What is my target position? And what is the root? That root is index future. In that root, if it is plus, long. In that root, if it is minus, short. Let it be negative beta, positive beta, complete hedge, partial hedge. Every possible situation is taken care in this format. Current, targets, the root is index futures. Okay. Actually, this can also be understood in one more manner. I'll tell you this. So actually, your position is 20,000 is the portfolio value, right? See, 20,000 multiplied by 3.5. So it'll come to 70,000. Anyway, I will present it separately, like the format we follow. That is, what is the position today and what is the position later. I will try to do it. But to achieve the 70,000, there is one more method. I'll just show you that as well. So you see, we have X limited and we have A limited. So if I break it down into two pieces, what is X limited value? 2,20,000. And what is X limited beta? 1.5. So 2,20,000 into 1.5, and that number comes to 3,30,000. Now, if only X limited was in your portfolio, if only X limited was in your portfolio, what position you would have taken in Nifty futures? In X limited, long position. Nifty, you would have taken short position. 1 plus 1 minus. So in Nifty futures, you would have taken short position 3,30,000. What would have been the similar case for A limited? You have 5,000 shares, 40 rupees. Oh, okay, amount we know, 2 lakh, and beta is 2. So 2 lakh into 2 is 4 lakh. And what is the position of this A limited? You have taken a short position. And hedging means I should do opposite. So opposite means in Nifty future, I should do long. So 4 lakh long. So 3,30,000 short and 4 lakh long, net long 70,000. See, I would have reached the same thing. I mean, I don't present you like this because 10 stocks are there. You can't do like this for every stock. But conceptually, this might be more convincing by doing it individually rather than overall. But for examination, still you do overall also, because that also carry marks. But conceptually, you can also understand this way. Okay, good. So if you're able to follow this one, then we'll present in the format what we usually follow. That is spot, future, today, next day. And this format, you can use it for options, for future, for forward, for foreign exchange, for arbitrage, anything, simple format we can follow. Okay, I hope you have taken down this. Let me go further. Simple format. Transaction today, transactions next day, market in spot market and in future market. And sometimes money market also can come. Why? Because if you want to enter into future contract, you need to put margin money. And for margin money, either there will be interest cost or there will be opportunity cost. So you can also have one more line for money market if there is any money to be borrowed. Okay, spot market means portfolio. Future market is Nifty future. And portfolio value, we know the amount already. Portfolio value, we calculated net amount. In the table we have prepared 20,000. Comprising of two things, that is X limited, or let me write separately, that is also fine. We have X limited 2,20,000. We have taken long position. Then A limited minus 2 lakh, and thereby overall net portfolio value we got 20,000. Nifty future formula, let's write it down. That is portfolio value multiplied by beta divided by the lot size into future price. This will give you number of contracts. Why number of contracts? Because Nifty's future is a contract and it is not traded in 1 unit or 2 unit. So lot size multiplied by future price gives you number of a value of one contract. And numerator, why do we do portfolio into beta? Because we are comparing a portfolio with index futures. Index future is like a market. And market beta is 1. Your portfolio beta is, let's say, 3.5. They're not comparable. If you make an equal allocation, they cannot cover same risk. So to make it equal, so even this Nifty future, you take 3.5 times position, so the risk becomes comparable. So value of exposure is portfolio into beta, and number of contracts is value of, 1 unit, that is future price, multiplied by lot size. That will give you value of one contract. So in this case, portfolio beta is 20,000 and beta is 3.5. Lot size, we don't have lot size. They said Nifty future 1,000 rupees. So future price is 1,000, but lot size we don't know. Let's take it as 1 unit, 1 lot. So that will give you number of contracts, number of units. 20,000 into 3.5 by 1,000. Now this number exactly we're getting it as 70, but sometime it may be 69.5, something like that. So we have to round off. So you may not achieve perfect hedging. So next day, okay, ultimately on X limited, you have taken long position. On A limited, you have taken short position. And on Nifty future, as we identified, you have taken long position. Next day, what happened? X limited dropped by 2%. X limited dropped by 2%. So X limited, there's going to be a loss. Because in long position, if the market falls, it is going to be a minus. So 2,20,000 into 2%. Think of 4,400 loss. In A limited, what happened? A limited appreciated by 3%. This is also a loss. Why? Because you took short position. In short position, if the price goes up against your expectation, again a loss. 2 lakh into 3%, so loss of 6,000. And what happened in Nifty future? Nifty future dropped and you have taken long position, so again a loss. A limited appreciated by 3%. Okay, so you got a loss. A Nifty future appreciated by, no, false. Future dropped. Oh, future dropped. Yeah, sorry, not up, dropped by 1.5%. But you have taken a long position, so this also is loss. 70 units of one uh, lot size, future price 1,000, nothing but 70,000 multiplied by 1.5%. 1,050 loss. So overall loss 4,400, 6,000, 1,050, 11,450. This is a very interesting situation. The purpose of hedging is to reduce loss. Perfect hedging is to make the loss zero. And we understood, okay, loss may not be exactly zero, but when you take some action, loss will come down. But by doing this hedging, your loss increased. Loss in all the three cases. I mean, very rarely this would happen, but this would happen. Okay, exam point of view, the solution is done. But just for our understanding purpose, what really went wrong? Why is the loss everywhere? The basic assumption of these calculation assume beta holds good. So if beta does not hold good, yes, there will be some difference. But sometimes it moves in opposite direction. Let's see what happened. What is the Nifty down by? Nifty down by 1.5%. Okay, if Nifty is down by 1.5%, and what is the beta of X Limited? X Limited beta is 1.5. So what should have happened if beta holds good? 1.5 times 1.5, market multiplied by beta. So X Limited would have fallen by 1.5 times 1.5, I think 2.25%. And if I do 2.25% of 2,20,000, it would be minus 4950, loss of 4950. Then second, what would have happened to A Limited? A Limited beta is 2. If Nifty falls by 1.5%, then what should happen to A Limited? A Limited should change by 2 times 3%. Yes, sir. Actually, only that is only happening 3%. No. Why? Please observe. If Nifty is down by 1.5%, your stock A Limited should be down by 3%. It should be down by 3%. It is up by 3%. It is in against direction what you thought of. And therefore, you would not have made a profit of 6,000. You would have made a lot loss of 6,000, profit of 6,000, and Nifty 1,050 loss. Now you calculate 4,950 loss, 6,000 profit, 1,050 loss. Overall, it would have become zero. So the culprit here is A Limited. When you have beta of 2, if the market falls, A Limited is supposed to fall. But what happened? It increased. Can happen. You think, oh, market is now bad. So in bad market, who will fall most? People risky. Company like Adani. Okay, let us short Adani. But what happened in the market? Nifty fell. Next day, Adani increased. So Nifty also, you have a loss. In Adani also you have a loss. Basically, I mean, you keep that aside. When you have a beta, based on that, hedging is done. If that holds good, your target is achieved. Sometimes things can go against you, so you might end up not achieving your goal. Anyway, that is aside. I hope you're able to calculate from the exam point of view. Can you please explain once again quickly today and next day treatment? Can you tell me, are you asking about the calculations or profit or loss? Profit or loss. Okay. That simply depends on the position you have taken. Long position, expecting the price to go up. If it happens, profit. Opposite happens, loss. Short position is bearish sentiment. So short position, expecting the price to come down. If it happens, profit. If not, loss. Let's look at what happened here. In X Limited, you have taken a long position and the price has fallen. Long position, expecting the price to go up. Opposite happened, so it's a loss. A Limited, you have taken short position. So short position means expecting the price to come down. But did it happen? No, it increased. Against your expectation, that is also a loss. So in stock market, you can make profit when market goes up. You can make profit when market comes down as long as your position is correct. If market is falling and you have taken long position, you end up in loss. Market is raising, you have taken short position, you end up in loss. So your position is important. Nifty future, you have taken long position and Nifty is down. So long position means expecting the price to go up. So it is down. So it is a loss. And why you are not able to achieve perfect hedge? The culprit is A Limited, which should have moved in tandem with market. Beta of 2 means if market falls, this should fall by 3%. Instead of that, A Limited raised. So it went against our expectations. That is why everything went haywire. Overall, you end up a ultimate loss. I hope you are able to understand individual breakup point and also overall calculations. Okay, that's about this one. Next question. Very popular question from Institute Material. In the exam, they have asked quite a few times, and this problem is an opportunity for us to understand many concepts. Let's go for it. A Limited of UK has imported some chemical worth US dollar 364897 from one of the US suppliers. Amount is payable in 6 months' time. Relevant spot rate forward rates are given. Spot rate, 6 months forward rate. Borrowing rates in UK and US are given. Deposit rates are also given. Currency options are available under which one option contract is GBP 12,500. The option premium for GBP at a strike price of US dollar 1.7 per GBP and USD for 6-month period. The company has three choices: forward cover, money market cover, currency option. Which of these three alternative is preferable? So this problem is not from Indian point of view, a typical challenge in examination. I think this is what you have also in the question. Yes, okay. Now, first of all, okay, so first of all, what is this overall requirement? A Limited of UK And whenever this UK comes, no, everywhere the problem only. Wherever the British people go, whether they play cricket, there's a controversy. They play football, there's a controversy. They have tennis, there's a controversy. Anyway, and they come in examination also, they will have a problem. Okay, so it is a problem from UK point of view. They have imported some chemical worth US dollar, that is their foreign currency. For them, USD is a foreign currency. They have imported from US suppliers. So what they have done, a company, this UK company, they have imported goods today from a US company, for which they are going to pay after 6 months. So this is today, and after 6 months, this UK company is going to repay, of course, along with interest. You pay USD plus interest to the supplier in US company. So if you have to pay US dollar, if a UK company has an obligation to pay the US dollar, they need the US dollar. So where they can get it? One option, they can get it in spot market on that date. On that date means after 6 months. And that rate we don't know. You will know the rate only on that 6 month point. Therefore, this is called as the unhedged position. This is called as unhedged position, risky position. Another option, instead of buying from spot market, you can buy from forward market. Means today only you are going to have enter into a contract, and this is called as forward hedging. Another one is there, money market hedging. You are going to borrow today itself and you deposit and you keep the money ready and then you repay it. So that is called as money market hedging. You use the technique of, I'll tell you the shortcut later. So you borrow and you deposit. You borrow in one currency, you deposit another currency, and that is called as money market hedging. And why it is called as money market hedging? Because you are using the concept of borrow and deposit. And then comes, you have one more option by using an option contract. So you become an option holder where you have a right to buy, and therefore using an option market, you buy, you become an option holder, and in the option you buy USD, and that is called as option hedging. I hope you got the overall view of this. As a UK company, I need to purchase US dollar for me to make the payment to my supplier. I can purchase from the open market, spot market after 6 months. That rate I don't know, that is unhedged position. Or I can buy from the forward market, for which today I enter into an agreement called as forward hedging. Or I can use a technique of borrow and deposit. I'll explain what is a borrow and deposit. That is called as money market hedging. And what is option hedging? That is using the concept of options. Being option holder, you have a right to buy, and you buy and you get the dollar, and you make the payment to your US company. I mean, you don't have to pay plus interest. I think supplier is not charging any interest, so you have to repay USD. That's all. If the supplier is charging any interest, then you need to add that element as well. I think there is no interest as such. Yes, exact amount is to be payable. Any doubts on this structure? So let me do the easier one first. That is forward hedging. Forward hedging is you have to consider whatever is the amount payable, that is whatever is the USD payable multiplied by the exchange rate. So only thing you have to apply is, should I multiply or should I divide? Now please tell me what currency is specified in the problem. US dollar, right? 364897. Now please take a look at this. Is this right hand side, left hand side? When they mean USD so much, it means it is one pound, one GBP equals 1.5617 USD or 1.5673. Okay, we don't require spot, right? We need a forward rate. So either it should be 1 GBP equals 1.5455 USD or 1.5609 USD. Okay, so currency what they've given is USD. Tell me right hand side or left hand side? Obviously it is right hand side. And what is the impact of right hand side? We need to divide. And what we have to do with respect to USD? I have to pay to my supplier means I have to purchase, right? That's what I've showed you. See, it has to come in either through forward market or through money market or through option market or through spot market. It has to come in. So you are purchasing. Purchasing will be at a higher rate, but you're dividing. So it will be 1 divided by the lower rate. So 1 by 1.5455. And this is US dollar 364897 multiplied by 1 by 1.5455. Three six four eight nine seven into 1 by 1.5455, 23610, 2.87, 236103. You can do decimals also. 236103. So this is forward hedge. And this is which currency? This cannot be in dollars, because when you apply exchange rate, the currency should be another one. So this is GBP. And UK point of view, this is the outflow. You're talking about importer. So he has to pay 236103 GBP to settlement, for the purpose of settlement after 6 months. See if you're able to follow. If it is fine, then I'll move towards money market hedging. Any doubts on this one? Done? Okay. Let me go further then. Next is money market hedging. Now, first I'll explain you the concept of money market hedging, then I'll give you the shortcut. The shortcut you can present in exam without making it look like a shortcut. I'll tell you. First, let me explain the concept. So let me write it very clearly so that you know this concept for understanding, not for writing an exam. Then for exam presentation, what is required, that also I'll write for exam presentation. Okay, now let me explain the concept. Going back to the original idea, what is that you're trying to achieve? After 6 months, you need US dollar, right? You need to get US dollar after 6 months. That means you have a liability after 6 months. You have to pay. You have an obligation of whatever the number, right? Now, what is hedging normally means? If you have a liability, you create an asset. If you have a liability, you create an asset, means you create a deposit of USD. Let me write like this only. You have a liability towards your supplier, correct? You have a liability towards your supplier, and hedging means taking opposite position, and therefore you create a deposit. Creating opposite position is ultimately the process involved in uh, hedging. Now, if you want to deposit, then you should have a deposit. I mean, this deposit will mature. This deposit will be maturing after 6 months. It will mature after 6 months. So you have to make a deposit today. You should make a deposit today. Okay, now please tell me this. How much is your invoice amount? 364,897 US dollars. And that is the deposit you would like to have. 364,897. Now, if you are going to have a deposit maturing at 364,897, today do you think you deposit same amount? See, after 6 months, it should become 364,897. So today, what should I do? I have to deposit at present value, correct? The present value using deposit rate. And how much I have to deposit rate? 364,897 divided by 1 plus, this is dollar deposit rate. And they have given the borrowing rates. Our deposit rates are 5.5 and 4.5 respectively. I need US. US is second number, and that is 4.5%. And that is for annual terms. So 0.045 into 6 by 12. So basically, how much deposits I need to do? 364,897 divided by 1.0225. 356,867. 356,867. 356,867. Now, this is the amount of deposit I have to make. If I have to deposit, where do I get the money? I have to borrow. So, I am going to borrow in pounds GBP. And how much you are going to borrow? How much our amount you require to deposit? So, you are going to purchase 356,867 in the market. And what is the rate? If you have to purchase, you go for spot. This is USD, right hand side, divide, buying at a higher rate. Higher rate is 1 by lower rate. So 1 by 1.5617. So 1 by 1.5617. So 356,867 into 1 by 1.5617, 228,512 something, right? 228,512. And this is the amount of GBP loan I take. Using that GBP, I'll buy deposit. And that deposit will get mature. You get the exact invoice amount. And using that invoice amount, you will pay your supplier. But this borrowing GBP, after 6 months, you have to repay along with interest. So what will be the interest on 228512, or I can multiply it by 1 plus borrowing of GBP. The borrowing of GBP, the first number UK, 7%. So 1 plus 0.07 into 6 by 12. So 1.035 multiply. 228512 into 1.035. 236509 or 510. 236510. 236510. Now this is the ultimate cash outflow after all this circus. You have a liability. For hedging purpose, you deposit and you create an asset. And for that asset, you have to deposit today. And have to deposit means I have to buy in market. For buying in market, I need borrowings. So from the invoice amount, present value, apply the exchange rate, then you have to borrow and then you have to repay. This is the overall concept. As a concept I have to explain. I have explained. Now I'll tell you how to present in examination. Okay. Now if I have to apply this quickly, what is effectively I'm doing mathematically, are you able to follow? From the 6 months later, I'm coming backwards and then again I'm going forward. In the sense, I'm calculating present value on one hand and future value on another hand. I'm discounting as well as compounding. Okay, let me write what I'm writing in effect. I've started with 364897. Then I am dividing it by 1 plus 0.055 into 6 by 12, 45, not 45, 45. Then I multiplied by the exchange rate 1.5617, dividing by, okay, this is 1 by 1.5617. Then after that I'm multiplying by 1 plus 0.07 into 6 by 12. So if you closely observe, I have one exchange rate. I'm multiplying by 1 plus some rate of interest and dividing it by 1 plus some rate of interest and multiplying by the invoice amount. Have you seen this calculation somewhere in life? The spot rate or the exchange rate multiplied by 1 plus R of one currency divided by 1 plus R of another currency. This is nothing but IRPT, right? Absolutely. So if you use the IRPT theorem formula, you get the answer in one line. The whole circus is not required. But if you present the exam in one line, that will not be considered correctly. So we have to write down 1 or 2 small steps to satisfy the validator. So what is the shortcut? I'll tell you. So examination presentation, we are going to follow this format. You start with whatever is the invoice amount multiplied by whatever is the spot rate multiplied by 1 plus local. In this case, UK is the company. So 1 plus GBP interest, or 1 plus GBP rate, interest rate, 1 plus GBP interest divided by 1 plus USD interest. So formula, one small thing will come. How do I know I should take a deposit rate or a borrowing rate? And how do I know I take a buy rate or a sell rate? Now, here I'm talking about a supplier, right? This is about an import transaction. For import transaction, what do? You buy goods, so you make it as spot buy rate. And importer means liability. Liability means borrowing. So GBP, you make it as borrowing, and denominator, you do the opposite, which is deposit. So did you understand the shortcut? Invoice amount into spot rate into 1 plus local by 1 plus foreign. For importer, I do spot buy. After all, importer job is to buy. And numerator, because importer means liability, borrowing, denominator, you make it as opposite, deposit. For the purpose of presentation in exam, you do this. The first step will happen denominator. What is in denominator is first step, spot buy rate second step, and numerator borrowing is the third step. So first step is you deposit in USD. Second step is you purchase in spot market. And last step is you repay along with interest. Okay, so take a look at this once more for 1 or 2 minutes. If you're able to understand the shortcut, ultimately in exam, you present that. Use the IRPT theorem. Denominator becomes first step, the spot rate is second step, numerator is third step. So 1, 2, 3. And verification, one line answer also you can write, but one line answer sometimes people don't give marks. So we'll break it down into 3 steps. So how much is deposit? How much is purchase? How much is repay along with interest? So invoice amount 367 64897 divided by 1 plus rate of interest is for USD deposit rate 4.5%. So 0.045 into 6 by 12, so 1.0225. So you get USD 356867. You purchase in the spot market, so 356867. You multiply it by buying at a higher rate because you're dividing 1 by lower rate. So 1 divided by 1.5617, you get GBP of 228512. When I apply the exchange rate, you get the pounds. Then you repay along with interest. So 228512 multiplied by 1 plus the borrowing rate for GBP is 7%, 0.07 into 6 by 12. So you get ultimate GBP repayment of 236510. So this is the ultimate outflow in money market hedging. Okay, so please write down carefully and see if you have any doubts. Okay, so hope you got the concept as well as presentation of money market hedging. If it is exporter, what will change? Invoice amount will be same. For exporter, it is not spot buy, it will become spot sell, and numerator is deposit rate, denominator is borrowing. That's only change if the problem was from a exporter point of view.
Sir?
Yes.
So if exporter, then you're saying we'll have spot sell,
Spot sell.
and then in the local currency we will deposit and foreign currency will buy.
Correct. Borrow. You mean
Huh?
local currency we will deposit, foreign currency we borrow. Numerator
Yeah.
is deposit, denominator is borrowing, just opposite.
Yes.
But local
Thank
will
you.
be numerator, foreign will be denominator, just like IRPT. That will not be opposite. The
Say it again, sir.
just like the IRPT formula, numerator is local, denominator foreign. That will not change. That will remain
Huh.
same. Only the borrowing and deposit will get interchanged. Okay. Okay. Next one is option hedging, but before that, I'll wait for 1 more minute. Any doubts in money market hedging? Anything that I need to explain once more, or any particular calculation? Okay, good. Let's go to option hedging. Option hedging. Okay. In option hedging, broadly, first you to understand there are three types of cash flows which will take place. And actually, one institute also usually misses, but I will take it. That is, in case of option, you pay premium immediately and you pay strike price on expiry date. And because premium is paid today and strike price is on expiry date, you also have to consider the time value of money on premium. Institute usually ignores that, but I will consider that also uh, in examination. But even if you ignore, that's completely fine. Okay, so cash flows will take place on 3 dates. But before we go to cash flows, you have determine what is the type of option applicable and how many number of contracts you have to enter into. That you should determine first. Then you are going to go for cash flows. Cash flows, that is premium. Then you are going to have the strike price. The premium is payable immediately. The strike price is on expiry date. Premium immediately and strike price on expiry date. Therefore, for time value of money, I will also consider interest on premium. But usually institute don't consider this, so even if you ignore, it's fine. But I would like to make sure that is also covered. And sometimes what happens, this number of contracts, because we'll have a lot size, you may not be able to fix exact the invoice amount because of a lot size limitation. Some fractional will come. So for that purpose, we'll go for any forward cover for fractional units, for fractions. So you have to remember these are the cash flows which will take place. And third point, sometimes Institute ignores it, most times. Now, type of option. Is it call option or put option? For that purpose, you have to first identify what is the underlying currency, or what is the uh, lot size, the underlying currency. So type of option, first underlying currency, and what is the transaction on underlying currency? Transaction on above. And based on that, you can determine the type of option. Okay, now what is the underlying currency in this problem? Please look at the problem. Look at the option data. Option contract is GBP 12,500. Therefore, underlying currency is GBP. And as an importer, what you are doing, please refer to a basic discussion. A UK person has to pay USD and therefore he has to buy USD. So in the option market, he has to buy USD. He has to buy USD. So normally if it is a buy, option to buy becomes a call option. But please observe, underlying currency is not USD. If I have to buy USD, that means I have to sell GBP. Why I have to convert like this? Because underlying unit is GBP. It's called the indirect quote. So in that case, the type, because it is sell GBP, it becomes put option. And number of contracts is calculated by the invoice amount divided by the lot size. But please observe, in this case, what is invoice amount? Invoice amount is US dollar something, but lot size is pounds. So when the invoice is in different currency, lot size is in different currency, it becomes invoice amount divided by strike price, and then you divide by lot size. This is applicable whenever the current invoice is different, lot size is different. In that case, this is applicable. So invoice amount is 364,897. Strike price is 1.7 per GBP. So 1.7 you divide by lot size. Lot size is 12,500. $17.17 will round off. So you get 17 contracts. So there is a fractional situation, and for the fraction purpose, we have to take a forward cover for fractional purpose. Okay, so what is the premium that you have to pay immediately? 17 contracts you are entering. Each contract have a lot size of 12,500 GBP, and it has a premium of, and what is a premium? For put option 0.096. 0.096, and this will give you 17 into 12,500 into 0.096, 20,400. And which currency it is? We have started with GBP, but when you multiply it by the premium, that works like an exchange rate. So what you get is USD. When you multiply by when you apply strike price, when you apply exchange rate, when you apply premium, the currency will be another currency. But the answer cannot be in dollar terms. Problem is UK percent point of view. So you have to convert this into spot rate. In other words, the person has to buy so much of US dollar from the market for him to pay premium. And this will come only when this is a reverse situation, indirect quote, like GBP here and USD here. Like invoice is in one currency and of underlying currency is another. When two different things are there, that is when this the extra step will come. And the buying rate, spot buy rate, we have already identified. One by lower rate, one by 1.5617. So now you get GBP 20,400 into 1 by 1.5617, 13,063. Interest, okay, strike price. The strike price is 1.7. Again, number of contracts is 17 into 12,500 GBP. I don't have to multiply it by 1.7 because ultimately I need the answer in GBP terms only. This is what I'm going to sell, I'm going to pay. So I can just do this, or if you multiply by 1.7, you get in dollar terms, then you divide by the exchange rate, again you get the same answer. So 1.7 into 12,500, 21,250. No, so 17 into 12,500, 2,12,500, sorry, 2,12,500. GBP 2,12,500. Okay, then interest on premium, as I told you, sometime institute ignores it. So, but I will consider for time value of money. So 13,000 in premium is 13,063. Pound borrowing terms. Pound borrowing is 7% into 6 by 12. 457. And forward cover for fractional one, to what extent USD is not covered. Okay, for that purpose, I think I should know this USD equivalent also. 17 into 12,500 into 1.7. That is 1.7 is the strike price. So what would be the coverage of USD there? 17 into 12,500 into 1.7. 361,250. This is the USD I purchase. But I need 364,897. So fractional will be 364,897 USD minus 361,250 multiplied by the forward cover, which we have calculated in the first part of it, which is 1 by 1.5455. That will give you the forward cover. 364,897 minus 361,250 into 1 by 1.5455. 2359, 2360, round it up. 2360. So this is the total cash flow, assuming option is exercised, of course. Maximum cash flow, you can say. 13,063, 12,500, 457, 2360, 228, 380. Okay, so ultimately, which is the lower cash flow? Here is 2,28. Here it is 2,36 and 2,36. So option hedging is the cheapest. So you can say that option hedging is beneficial. Being from importer point of view, the cheapest is best. Okay, so this is what is option, and similarly if it was future also, you follow same process. There also you will go for instead of strike price, you go for future price.
So,
Yes, please.
this in the question, one option contract is GBP 12,500. No,
Correct. That is what lot size.
that is one lot. Price is 12,500.
One contract is 12,500 GBP. One contract.
Okay, and then in the number of contracts, you said invoice amount divided by strike price, then whole divided by lot
Lot size.
size.
That is for number of contracts. When you divide
Yeah,
by strike price only when they are in different currencies.
and if they are not in different currency, we just remove the strike price.
Correct. Just invoice by lot size is sufficient. The reason is the invoice is in one currency, lot size another. So how do you convert? Using the strike price. So invoice by strike price will give me the answer in pounds, because US dollar, when I apply strike price, I get pounds, and lot size also in pounds. So both are in same currency. I can calculate the number of contracts. If it is in same currency already, I don't have to divide. Simply I take invoice by lot size, I get the number of contracts. Okay, so I hope this is fine then. Can you show the forward contract slide? You can take a screenshot. Forward contract, I think you mean the first one. This one, where I've shown you the multiple options. Done? Okay, good. Okay, so if anybody wants to take a picture of the money market hedging, and if it is option hedging. Okay, so let's go further. Okay, on April 3rd, a bank quotes the following spot exchange rate, uh, two rates. I mean, like bid rate, offer rate, one lower rate, one higher rate. 2 month swap points, 3 month swap points. So, what's the meaning of swap points? You have a spot rate, means for settlement for today transaction, and if you want for settlement at a later date, I don't want today to settle, I want later date. So in that case, you go for spot price plus swap points if they are increasing in order, minus swap points if they are decreasing in order. The starting point plus the swap point will give you the forward rate. In spot transaction, delivery is made after 2 days, that is on April 5th. Assume one swap point is 0.00001. You require to ascertain the swap points for 2 months and 15 days. That is for June 20th, because 2 months 15 days start from April 5th. If you count 2 months 15 days means becomes June 20th. 2 months, that is after April, May, June. From 5th of April, 15 days means 28th of June. Determine the exchange rate for June 20th. Compute the annual rate of premium or discount on an average rate. Okay. So please look at this number. Swap points are 70-90. When swap points are increasing, we need to add. Anyway, they are asking us to calculate for swap month for 2 months and 15 days. So for 2 months, it is 70 points. For 3 months, it is 160 points. So in between the two, we have to interpolate. Let's calculate that. So first part of the question, swap points for 2 months, 15 days. So for 2 months, the swap points are 70, 160, 70, and one more is given that I'll come to it later. For 3 months, is given as 160. They want for 2 months, 15 days. Let's do an interpolation method. Interpolation method means 2 months to 3 months, the time gap is 1 month. Means let me take 30 days. And 70 to 160, so the time gap is 90. And how much for 15 days? So for 1 month, I mean for 30 days, it is 90 points. And if it is for 15 days, what is the incremental points? Incremental 30 days, incremental 90 points. We just need for 15 days. So cross multiply 15 into 90 divided by 30. So you get 45 points. 45. So incremental is 45. For 2 months, it is 70 points. And for 15 days, 45 points. So what is for 2 months, 15 days? That is 70 points plus 45. You get 115. This is for bid rate or offer rate when we have two rates. And another one, we have 90 and 186. So 90 and 186. Similar one, can you try? 90 to 186 means 96. Proportionately you calculate and tell me what is the other number you get here. One number we got, the bid rate 115, I mean the offer rate is what we have to calculate. Two things, bid rate, offer rate. Bid rate 115, offer rate 138. Hope you're getting it. 138. And you see 115, 138. We say that swap points are increasing order. Increasing order means we have to do plus. It's going to increase. That's what the second part of the question. Foreign exchange rate on June 20th. Foreign exchange rate on June 30th. Basically, we have to calculate forward rate. And forward rate is calculated as swap points are increasing. See 115, 138. We say ascending order. Swap points are ascending order. So forward is given as spot plus swap points. And again, we have bid rate and offer rate. Two rates are given. We have to add two swap points. And we are on April 3rd, but it takes 2 days to delivery. So you count from April 5th. And from April 5th to June 30th, June 20th. So 2 months and 15 days. And what we have calculated in first part of the problem, 2 months and 15 days only. So spot price is the given. So forward is given by 66.2525 and another one 67.5945. And when it is 115, you always please take it as 4 decimals. I mean, you take it as right to left. You understand my point? And they also have given swap point represent that 0.00001. So for simplicity, I'm telling you, you add from right to left. That is 115. Last 3 digits. If they give you 2 digits, last 2 digits. Like a Urdu style. Read from right to left. So, and then you can put 0 for reference. So here also you can add last digits 138. Add from right to left. And if whatever missing, you can put 0. $66.2525 by 0.0115, 66.264. 7.5945 plus 0.0138, 67.608. Okay. Okay. And third part of the question. Uh, Annual rate of premium or discount. That is forward premium or discount. In this case, it's adding. So we are going to calculate forward premium. Annual rate of forward premium or discount. In this problem, it's going to be premium because it is spot rate more than, forward rate more than spot rate. It's called as premium. So forward rate more than spot rate. So it is called as premium. Okay. And what is the formula for premium? What we are going to calculate? This is like, P1 minus P0 by P0 into 100. Like in portfolio management, what you calculate it. So forward rate minus spot rate divided by spot rate into 100. But to express in annual terms, into 12 divided by number of months. Normal formula is this. Forward rate is like a P1. Spot rate is like P0 by spot rate. But in this problem, they said, please read, compute the annual rate of discount on an average rate. So the denominator is not spot rate. The denominator is going to be forward rate plus spot rate divided by 2. This is because the question said take it based on average rate. For this reason. So forward, again we have bid rate, offer rate, two numbers we are going to calculate. Let's just apply this. On first one, 66.264 minus spot rate 66.2525 whole divided by forward plus spot rate 66.264 plus 66.2525 divided by 2. Then to express in percentage multiplied by 100, and this is for 12 months. This is for how many months? 2 months 15 days. So I can take it like 2.5, 2 months 15 days. So divide by 2.5. So this one I will calculate for you. The other one, the offer rate that you calculate. 66.264 minus 66.2525, 0.0115, and don't get surprised, this is nothing but the swap points which we have added. Anyway, divide by 66.264 plus 66.2525 divided by 2, 66.25825. 66.25825 multiplied by 100 multiplied by 12 by 2.5. I think you get 0.083%. Okay, so like this, you also calculate for the other one, second part of it, and tell me how much you get. So one number you get 0.083%, another number you try. Okay, you can try. The answer actually comes to 0.098%. You can try it out. I hope that number you should be able to get it. Okay, next. Okay, so this is one more problem variety, where one more variety I would say, where a foreign company coming into India is asked, more practical one, but simple one. I mean, simple in terms of practical application, but from a student point of view, I understand this is slightly complicated. But examination they've asked, so let's do it. A USA-based company is planning to set up a software development unit in India. Software developed at Indian unit will be bought back by US parent at a transfer price of US 10 millions. The unit will remain in existence in India for 1 year. The software is expected to be get developed within this time frame. US based company will be subject to corporate tax of 30% and withholding tax of 10% in India, and will not be eligible for tax credit in US. So the 10% will be like an expense. The software developed will be sold in US market for US dollar 20 millions. Other estimates are as follows. Rent for fully furnished unit with necessary hardware in India. Manpower cost 80 software professional will be working for 80 hours, 10 hours each day, 10 hours each day, good, 400 per man hour. Administrative cost, advise the company on the financial viability of the project. Rupee dollar rate is rupees 48 per dollar. The important point in this case is the unit will remain in existence only for 1 year. So no need to worry too much about the present value, discounting factor, investment concepts. Okay, so this is a very practical scenario. This is happening, this will happen. So if you becoming, controller, CFOs, virtual CFOs of some corporate companies, these situations will come across day in and day out. Okay, let's understand the context. A USA based company is planning to set up software development in India. Okay, there is one USA company, or let's say company in USA. They have a unit, and they are planning to software development in India. So software unit in India. Unit will be bought back by US parent after transfer, and the US company will be subjected, and the software will be developed, will be sold in US market for 12 million. So try to understand the context. This software unit will be sold at cost of 10 million, and this unit, I mean whatever the USA purchased, and they will sell it to outsiders, customers, clients, for US dollar of 12 million. Now this is the cash inflow, right? I mean the goods will be sold, and that means basically for a USA, inflow is 12 million dollars from the clients, and 10 million they will pay to the software unit, and the software unit incur some expenses. How much expenses they are going to incur? um, this is the rental cost. Then they will have a manpower cost. Then they have administrative cost. Okay, now please try to make sure you think the problem from the ultimate company point of view, USA company point of view. What are their inflows and what are their outflows? Keep trying to think on those lines. These rental cost, manpower cost, admin cost are all expenses of software unit, and they are going to sell 10 million. So that is their sales. So if you think from software unit in India point of view, they have a sales and they have expenses. Salesman's expense means you get profit, and the profit they will be subject to tax. You get profit after tax, and there also there will be some withholding tax you take out, and that amount will be belonging to the company in USA. So as far as cash flow is concerned, cash flow is always our god. As far as cash flow is concerned, what the USA company get is the profit of the software unit minus tax, minus withholding tax, net amount what they get. So that is their inflow. So from the USA company point of view, they will receive $12 million, and they will receive this profit element, and they will pay this 10 million. That is the cash inflows and outflows from the company point of view. I hope you got the overall structure, how it would play out. Okay, so how the decision is going to be there? So if I have to quickly write down the steps, so heading has to be from USA company point of view. Okay, so what is their sales? Their sales is $12 million to the client. Less cost. The cost is cost of development, you can say. Cost of development in the sense how much they are paying to Indian unit is 10 million. But 10 million is what they are paying. They receive something also, and that is less share of profit, which we are going to calculate. Share of profit, whatever that number comes. So when I subtract the share of profit, what I get is the net cost. We'll calculate whatever the net cost. And from 12 million, I subtract net cost, then that is what profitability of project, overall profitability of project. I hope you got the idea behind which this question is asked. Think from the USA company point of view. They are selling their customer for 12 million. I mean, they are selling to customer for 12 million, and they are paying to Indian unit to acquire that software 10 million. So if I see it at a gross level, 12 million is my outflow, inflow. 10 million is the amount which I purchasing. So 12 sales minus cost, 10, 2 million I get. Apart from this, I also get a profit from the software unit because I'm the owner. I'll get the share of profit. Any doubts in the context? Anything that need to be explained? This also been asked in the exam quite a few times. Is it fine? Shall I go to the calculation part of it now? Not sure if I'm able to communicate. Is it fine? Any doubts? Yes? Okay, thank you. Good. Okay, so whatever the format I told you, the structure what I told you, now we are going to calculate here fresh, and in exam you can present this. Overall profitability from USA company point of view. Sale proceeds, or proceeds from sales to customers, proceeds from sales to customers. You can say $1 million, which is 12. Then cost of development, paid to Indian subsidiary, which is 10 million, less received from Indian subsidiary. Means profitability basically. So let's calculate sales. Sales of Indian subsidiary is 10 million. So apply exchange rate. Exchange rate given, should be given. 48. 10 million into 48. So 480. Less all these cost. Oh, this is some challenge in number of units. I mean, that zero and all. So when too many confusion comes, 1 million, 10 lakh, 10 crore, what do you do best? You simply convert into full number. Or you can also do, if you want to convert into, crores kind of thing, 1 million will have 5 zeros, crores will have 7 zeros, you have to take out 2 zeros out. Or if you want to convert million into crores, you have to put 2 zeros further. But anyway, let's write the full amount for more safety purpose. So 480 million. So 480 followed by 6 zeros. So if I put it, you get 48 crores, I think. Less all these cost, one by one. Rent 15 lakh. Is it per month or something? No, full 15 lakh. Rent 15 lakh. That's all. For 45 lakhs, 48 lakhs, you get 15 lakh rent. Okay, maybe manpower will be the important cost. Manpower cost, 80 software, 10 hours each day, 400 per man hour. 80, 10 hours, 400 per man hour. 80 into 10 into 400. This is each day. We should know how many days also, no? This is full for full year. How many days in the year have they given somewhere?
So it's given in the last line. Note assume 365 days a year.
Maybe, I mean, in this material, I think I missed it out. So, okay, it is there at the bottom. So,
In the material that you gave us, sir.
yeah, there, which is basically RTP question. So you can multiply it by 365. Again, so we can say into 365. But of course, there are maybe questions we don't give any holidays. That we Indians, we work between the holidays only. And for exam purpose, they said 365 days. So let's go with that. So 80 into 10 into 400 into 365. So 11 crores 68 lakhs. This is also an expense. Administrative cost 12 lakh. No other expenses. So you can say profit before tax. 48 crores minus 15 lakhs minus 11.68 crores minus 12 lakhs. 36 crores 5 lakhs. Less tax. Indian tax rate, US company will be subjected to corporate tax of 30%. So into 30. No, it's 36 crores 5 lakh, right? Not 36 lakh, sorry. I think 36 crores. Yeah, I think this is correct. 36 crore 5 lakh. 36 crore 5 lakhs into 30%. 10 crore 81 lakh 50,000. So profit after tax 25 23 50,000. 25 crore 23,000 to 23 lakh 50,000. Now this also is actually profitability belonging to the USA company? Can they withdraw entire amount? There is a restriction. You have a withholding tax of 10%. So from this, you have to cut 10%. And they also said it is not allowable as a tax credit. Means you can't use it as a set off against your tax liability in US. So this is not going to be anything. In other words, this cannot be withdrawn. This has no other benefit. You simply subtract less withholding tax. 10%. 252, 35,000. So what is the cash flow you get? Cash flow that you can withdraw, which are repatriable, you can say. Cash flow with repatriable. 2271, 15,000. 2271, 15,000. 50,000. 2271, 15,000. 2271, 15,000. Okay, then we have to convert this into dollar terms. So rupees to dollar means I will divide by 48 and I have to convert it dollar million. How do you convert the rupees crores into dollar million? Rupee will have 7 zeros, million will have just 5 zeros. So I have to take out 2 zeros. So I will have to divide by 100.
So million will have six
Million
zeros.
60. So I have to divide by 10. I think 10 if I divide is sufficient. So crore is 7 or I think I'm writing full amount. You can simply divide by 1 million. I mean, I'm not writing in crores, right? I'm writing full amount. So I don't have to take only 10 and all. I simply divide by 1 million means 10 lakh. So whatever the number you have, simply divide it by 1 million means 6 zeros. So divide by 48 and divided by 1 million. You get a 4.73. Yeah, so you get 4.73. So 10 million is what you pay, 4.73 is what you receive. So net cost. Ten minus 4.73, 5.27. So 12 million is what you pay, sorry, what you receive. 5.27 is your net cost. So profitability, you get 6.7. Overall profitability. Overall profit. You can also say like this. The proceeds from the customer is 12. Cost of development is 5.27. So it is beneficial. You can also say like that. The cost is less, the benefit is more. Okay, so this is a problem again on a typical situation that would arise in a practical scenario. See if you have any doubts. Okay, great. Good. Okay, so let us take up the next problem. I think this is the next problem. XYZ Limited borrows 15 million of 6 months LIBOR plus 10% for a period of 24 months. You can't hear. Uh, is it the case with others also? I mean, are you able to hear others? Able to hear, okay. Then please check. Okay. Okay, fine. XYZ Limit borrows 15 million for 6 months LIBOR plus 10% for a period of 24 months. The company anticipates a rise in LIBOR and hence it proposes to buy cap option from the bank at a strike rate of 8%. The lump sum premium is 1%. The entire reset period and the fixed rate is 7% per annum. The actual position of the LIBOR during the forthcoming reset period is as under reset period 1, 2, 3. You require to show how far interest risk is hedged through cap option. For calculation, work out the figures at each stage up to 4 decimal points and amount nearest to the pounds. It should be part of working notes. Okay. They have situation of borrowing. A borrower is worried about increase in interest rates and therefore they have gone for interest rate cap option. Cap is nothing but call option. Whenever interest rate increase, you end up exercising. Means when interest rate increase in your borrowing, you pay extra, because if interest rate increases, you end up paying extra amount, and that extra amount you receive in the form of options. That is, you receive, right, when the expiry date is there, you receive intrinsic value. Of course, premium amount you would have paid. First of all, in this problem, premium amount they have not given. They just said the lump sum premium is 1%. That means for the entire contract period, it is 1%. Contract period is 24 months, 2 years. Now, in 24 months, how many settlements will take place? This is a problem of 6 months, right? 6 months Libor. So you make the payment interest every 6 months. So the settlement here also will take place every 6 months. Contract period is 24 months. Settlement will be 6 months at once. So how many times it will take place? 24 months divided by 6 months. 4 settlements it will take place. They have given 3. That is, they have not given the fourth, but let's calculate whatever given. But for calculating premium, you have to consider the 4 reset periods, 4 terms involved. So let's calculate that. Premium paid. How much is the premium paid? 15 million is the amount of borrowing, and that is the notional principal we can say, and lump sum premium is 1%. So 15 million, 15 followed by 1% for, I mean, how much you get? 1,50,000, right? Now, this 1,50,000 is not paid per annum. It is for entire contract period. So this is applicable for a period of 24 months. And settlement will take place after every 6 months. So settlement after every 6 months. So can we say 1,50,000 divided by 4? That would not be correct because time value of money would not be considered in that case. And therefore, let's not divide by 4. Let's divide by annuity factor for 4 periods. So let's convert it to premium in premium equivalent for every term, premium equivalent for every term for every 6 months is calculated by whatever the lump sum premium divided by annuity factor at certain percentage for the number of term. Lump sum is 1,50,000, which is the present value, divided by the annuity factor. The rate of interest, they said you take fixed rate of 7%, and for a period of number of terms, so 24 months and 6 months once means you get 4 terms. So how do you get annuity factor? 1 by 1.07 because 7% is the rate of interest, equal to 4 times because 4 terms, 4 times 6 months will come, and then press GT. So 1,50,000 divided by, can you tell me how much annuity factor will get? Oh, sorry, not 7%. I have to make it as 3.5%, right? 7% is for full year. This for half year. Please make it as 3.5%. Please make it as 3.5%, not 0.07, 0.035. 0.035. Please make a correction there. It's not 7%. 7% is for per annum. For a half yearly, it becomes 3.5%. 1 by 1.035. 1, 2, 3, 4. 3.673, right? 3.673, 3.6731. Are you getting that number? 3.6731. Institute sometimes uses this complicated formula. Let me put that for you. Just want to show you that we also get the same answer, but sometimes institute will put this complicated formula. Yeah, we have it. Good. See, some institute will show something like this big formula. RP 1 by I minus 1 by I into 1 plus I into A. That is, and they also said, or whatever the premium amount divided by present value interest factor, annuity factor, 3.5% for 4 terms. That's what we also did. So they have taken 3 decimals and they've added, they got 3.671 and we got 3.6731. I hope you're able to get that number, 3.6731. So 1,50,000 divided by 3.6731, 40,837. And some round off, you get a small differential. I think institute got 40,600 something. Okay, so please check if you're able to understand till here on all the calculation of premium amounts. Okay, is it done till here? Please confirm. Yes, okay. Then premium we have calculated. What is the requirement? You are required to show how far the interest rate risk is hedged through cap option. So what we are going to do, we'll calculate what institute has recommended, how much incremental interest that you pay due to the increase in interest rate and how much you are able to recover by the uh, interest rate options. So what is the additional interest? Reset period. They have given 3 reset periods and LIBOR rate what they have given. That is 9.5, 10. And then we're going to calculate. So what is the additional interest? You are going to pay. Means what is the rate as per the contract and how much is the LIBOR rate? Of course, the contract rate is, strike rate is 8%, LIBOR 9, 9.5, 10. So in all the 3 cases, option is exercised. All the 3 cases, market rate is more. When the market rate is more, option is exercised. And therefore, what is the amount? Additional interest means from 8%, the extra part. So 9% minus 8% multiplied by 15 million and for a period of 6 months into 6 by 12. So what is the amount you get? 9 minus 8 means 1%. 1% of 15 million, 15 followed by 6 zeros into 6 by 12. So how much you get? So 75,000. Okay. So that is 75,000. Okay. Now this is what is paid in additional interest because of increase in the LIBOR rate as under the in loan. What is the amount what you do in options? Options means you will have intrinsic value, then you have premium, and then payoff. Now intrinsic value will come when the option is exercised and the calculation is same. 75,000 is what you are going to get. The rate is 9%, strike rate is 8%. When the market rate is more, option is exercised and difference becomes intrinsic value. So the calculation is same. 9 minus 8 into 15 million into 6 by 12. Premium 40,837 and the differential amount is your payoff. 75,000 minus 40,837. 34,163. So this is the net amount you receive from the interest rate caps. So additional interest in the second case again increased. So 9.5% minus 8% into 15 million into 6 by 12.
Sir,
Yes.
there was some problem in my system, which because of which I couldn't hear you. Now it's
Yes.
rectified. Can you just quickly tell me a summary of what we are doing? Because I tried understanding on my own, I'm not able to figure it out.
So it is a case of borrower position and the borrower is trying to hedge through interest rate caps. And interest rate caps you have paid premium, they said 1%, and is 1% for full term, one lump sum payment. But we are going to have 4 reset periods, so we don't do divide by 4, we divide by the annuity factor, so that it expressed in the every term once, every reset period once. So we don't divide by 4, we divide by annuity factor for time value of money. That will give you 40,837. There's a premium paid in case of interest rate caps. Then they have given the LIBOR rate, which is nothing but a market rate. Now, when LIBOR rate is 9%, strike rate is 8. So 1% is the extra interest that you pay due to the changes in the market rates. That is what they're asking in the problem. How far your interest risk is hedged. Interest risk is how much extra interest you pay and how much you could recover it, how much you could minimize it. This is the additional interest you are paying because of increase in the interest rates. Now in options, when the option is exercised, you get intrinsic value, which is calculation is same, 9 minus 8, I mean into 15 million into 6 by 12. So you get 75,000. Premium you paid, I've calculated 49,837, and payoff in options 75,000 minus 40,837. 34,163. What is 71? Are you telling total or something? Maybe. Okay. So first year, first period, it is 34,163. So what is the understanding? Because of interest increase in interest rate, you are paying extra 75,000, but 34,163 you could recover with the help of the options. To that extent, your interest rate loss is minimized. Similarly, second year, 9.5% into 8%. I think that will give you 1.5% of 15 million. So much you get? 1,12,500. And intrinsic value is difference between the strike rate and the market rate, which is again comes to 1,12,500. The premium amount is 40,837. That is the fixed amount. I think this is the amount you're telling. Minus 40,837, 71,663. At 10%, again market rate is high. Call option is exercised, cash is exercised. 10% minus 8%. So 2% is the additional amount you're paying into 50 million into 6 by 12. So that comes to 1,50,000. This also will be 1,50,000. Premium 40,837. 1,50,000 minus 40,837. 109,163. That's the payoff. So what is the additional total interest you paid? Additional over a period of 3 periods, 3 terms. Additional interest is 1,50,000, 75, 1,12,500. 3,37,500. And how much you have recovered because you could hedge this by entering into interest rate options. 2,14,989. So even though interest rate increased and you end up paying additional 3,37,500, you could recover in the options to the extent of 2,14,989. So you could reduce the impact of increase. That is what is called as hedging. That is what is they're trying to understand how much you could cover by entering into interest rate options. Take a look at the problem once more and the solution. See if you have any doubts.
Sir,
Yes, please.
this percentage of 7% is of no use in our calculation, right?
No, it is used for calculating annuity factor. We have taken 3.5%.
Half rate. Okay,
That
sir.
is half of 7. That is only used. There is only place where it is used. If they have given the annual lump sum or a periodical premium already, then that would not be required.
Sir, in this case, the X Limited has to pay LIBOR plus 10% to the borrower,
Correct. LIBOR plus 10%, that will be their actual interest.
actual interest, and in cap, he is getting 8% cap, so the only 1% he has to pay from his pocket.
No, don't compare that way. No, you mean 8 to 9%. Yes, that 8 to 9, that extra 1% is what he has to pay. He will get from the premium. In the sense, what is this? I mean, LIBOR plus 10% is actually slightly more, you know, overstretched. But anyway, for discussion purpose, let's have it. See, we have LIBOR plus 10%, and currently it is 8%. That means his current outflow is 18%,
Yes, sir.
which is he's okay with existing now. He's
Correct.
only worried about his increase rates. Increase means it has become 9. So how much additional it will become, and how much will be the new rate of interest now? It will be
19.
LIBOR plus 10 plus 9. It will become 19%. So he has paid that extra 1%. That is what he will recover from the options. And that extra 1% is what this 9 minus 8 also would mean. I mean, you can also do 19 minus 18% for calculation purpose. That extra increase in interest rate is what is trying to recover by using this instrument.
Okay, sir. Thank you.
Yeah, and I think this should be not 10%, it may be 10 basis points. It should be 0.1% in my opinion. But anyway, that's not used because we're just trying to calculate the incremental interest. If you want to calculate actual interest, then what we should do, it will become 19% if you take the 10 as it is, into 15 million, into 6 by 12, into, I mean, this will be the actual interest minus the payoff what we get. That will be net interest cost. So in the exam, if they ask you the net interest cost, we go by that. We calculate the actual interest cost, and whatever we have received from the option, we will subtract. That will be the net interest cost by considering both loan and the option together. Then since they have not asked the net interest cost, we have not calculated it.
Okay, sir.
Yep. See if you have any other doubts.
So can you show the solution once again?
Yes.
So, in case of normal option, a call option is the right to buy some shares at for the strike price.
Call option
So,
is
in
right to buy. Correct.
right to buy, and in case of cap options, it is a right to
Borrow
borrow at the strike
8%.
rate.
At strike rate at 8%. And if interest
Okay.
rate increases, whatever the incremental interest cost, that you will get. Just like
Oh,
there, in option, it will be market price minus strike price. Here, market rate minus strike rate. The market
un-
rate here is LIBOR.
understood. Thank you.
Okay, let's go further. Delta Limited's current financial income statement reports net income of 15 lakhs. Net income means profit after tax. Net income means profit after tax. Delta's marginal tax rate is 40% and interest expense for the year was 15 lakhs. The company has 1 crore of invested capital. Invested capital means capital employed, of which 60% is debt. Of course, balance 40% is equity. In addition, Delta Limited tries to maintain a weighted average cost of capital of 12.6, that is WACC. Compute the operating income or EBIT earned by Delta Limited in the current year. So we have profit after tax. So to go back to EBIT, I should add back tax and I should add back interest. What is Delta Limited's economic value added for the year? Delta Limited has 250,000 shares outstanding. According to EVA computed, how much Delta Limited can pay dividend the share before the value of company would start to decrease. If Delta does not pay any amount of dividend, then what would have expect to happen to the value of the company? Okay, so one term we are applying, EVA. Let me try to talk about it in quick terms and then I'll go for the calculation. Economic value added is like in life. What is the formula for happiness? I don't know how other people view it. According to me, happiness is the difference between what you get and what you expect. You expect 90 marks, you get 89, you feel bad. You expect 50 marks, you get 89, you are overjoyed. It's all about expectations. From the company point of view also, the value addition from the investors point of view, from the shareholders as well as the debt providers, the capital employed point of view, what it is generating minus what it is expected. So formula I can write like this: actual minus expected. Even in company, you receive the money from shareholders. Shareholders have an expectation in your company. If you exceed their expectation, that is the value addition you are doing over and above what is being expected. Trying to put slightly philosophical way, some people were complaining in life that I don't have proper shoes to play football, whereas some people were complaining they did not have ground to play football. And some people were complaining they don't have legs to play football. Right? So it's all about expectations anyway. So actual is called as NOPAT, net operating profit after tax. So operating profit, do not consider interest, but after tax. Minus expected profit. So on the capital employed, what is the expected rate of return? That is called as WACC, cost of capital. On the invested amount, how much return expected, but if you achieve more than that, that is the value addition called as economic value added. NOPAT can be calculated in two ways. If you know the EBIT, then you can do into 1 minus t, so you get after tax without considering interest. Or if you know profit after tax, you can add back interest into 1 minus t after tax, then also will give you net operating profit after tax. So basically I'm taking interest element out. From the firm point of view, what is the cash inflow? Anyway, this is a concept. Let me write what is asked in the problem. We'll go in that order. Compute the operating income or EBIT. First thing is to calculate the EBIT. So what is the formula for EBIT? If I just go in a reverse order, we will have EBIT minus interest. We get EBT. You subtract tax. You get profit after tax. And in the problem, they have given profit after tax net income of 15 lakhs. And how much you have to go backwards. They want operating profit, they want EBIT. You have to go upwards. So tax should be added back, and later interest should be added back. So how much is the tax amount? Tax rate is 40%. So if your earnings before tax is 100, tax is 40, so profit after tax is 60. So cross multiply 15 lakh into 40 divided by 60. Ten lakhs. So what will be profit before tax? 15 lakh plus 10 lakh, and that is 25 lakhs. Or you can also calculate profit before tax can be calculated as profit after tax by 1 minus T. Profit after tax is 15 lakhs. Divide by 1 minus tax rate by 1.4. So 15 lakh by 0.6. You get same number, 25 lakh. So both ways fine. Add back interest. Interest, they said the capital employed is 1 lakh, out of which debt is 60%. What is rate of interest? Oh, rate of interest they are not given. Then how do we calculate the interest amount? They have given. Sorry, interest expense is given. Interest expense for the year is 15 lakh. That's straight away given. Let's make use of it. So interest is 15 lakh given. So 25 plus 15. So EBIT becomes 40 lakh. So you can say that. So operating income is 40 lakh. EBIT before tax. Okay. Second question. They've asked about the EVA. Economic value added is calculated as NOPAT minus capital employed into WACC, and NOPAT, as I told you, you can calculate as EBIT into 1 minus tax rate. So NOPAT is EBIT is 40 lakhs into 1 minus tax rate is 40%, minus capital employed is 1 crore, and the WACC is also given, which is 12.6%. So NOPAT 40 lakhs into 0.6, that is 24 lakhs. 1 crore into 12.6, so 12 lakh 60,000. So 24 lakh minus 12 lakh 60,000, 11 lakh 40,000. So what do you mean by 11 lakh 40,000? It does not mean they're making a profit of 11 lakh 40. They were exceeding the expectations when EVA is positive. And if EVA was negative, does not mean they make loss. They just mean they fell short of expectations. EVA is a standard thing for estimation of expectations. EVA is positive. You have exceeded the shareholders' expectations. And that is a value addition because of the company's decisions and operations. Right. And what else they've asked in the question? If they have 2,50,000, how much Delta pay dividend per share? See, as I just told you, what is EVA? Surplus money, I can say. So whatever is the extra money you generate, you pay them as dividend. Shareholders also will happy. They were expecting so much, you got little bit extra, so whatever the extra, give them, let them enjoy. So dividend per share can be DPS, dividend per share 11,40,000 divided by number of shares 2,50,000. I mean, you can pay dividend based on different policy, different methods. One of them is EVA method, distributing EVA as dividend. 11,40,000 divided by 2,50,000, 4.56 per share. And second, if Delta does not pay any dividend, then what would expect to happen to the value of company? If you don't distribute, value of the company will be higher, so share price also will be higher. So you can write down that point. If dividend is not paid, value of the company will be higher. Value of the company will be higher. If dividend is not paid, value of the company will be higher. Okay, I hope it is done. We'll move further. Okay, so let us read the last one. AFC Limited wishes to acquire BZD Limited. The shares issued by the two companies are 10 lakh and 5 lakh respectively. Calculate increase in the total value of BCD Limited resulting from the acquisition on the basis of the following conditions. Current expected growth rate of BCD Limited 7%. Expected growth rate of AFC Limited. AFC is the acquirer. Without any additional capital requirement or without any change of risk operations, 8%. So BCD Limited target is 7. Growth rate of AFC acquirer is 8. Current market price is 120. Expected dividend per share of BCD Limited is 0.6. On the basis of the aforesaid conditions and calculate the gain or loss to the shareholders of both the companies if AFC Limited were to offer 1 share for every 4 shares, swap ratio 1:4. Calculate the gain to shareholders of both the company if AFC Limited pays 22 for each BCD Limited. If they pay 22, settlement, purchase consideration by issue of not shares, cash. Assuming P ratio does not change after the merger, EPS of AFC Limited is rupees 8 and BCD is 2.5. It is assumed that AFC invests its cash to earn 10%. That works like an opportunity cost. So only 3 sub questions, right? Okay, that is great. Let's write down in the standard format. That is AFC BCD. AFC, which is the acquirer, BCD, the target, and then merged entity. Whatever regular information we'll write down, that is EPS or earnings. If information not available, we'll keep it blank. Number of shares, you get EPS, then P ratio, you get MPS, then maybe market value. Anyway, earnings we don't know. Number of shares we know 10 lakh and 5 lakh. Number of shares 10 lakh, 5 lakh. A growth rate they have given. Okay, expected growth rate. AFC, BCD is 7. and AFC is 8. Growth rate, a market price of AFC is 100 and market price of BCD is 20 and expected dividend 0.6. Oh, EPS is given. EPS 8 and 2.5. EPS 8 and 2.5. They have given expected dividend. Expected dividend of BCD 0.6. Okay, so first thing is to keep the data available, which we have done. And what is the requirement of first part of the question? Calculate the increase in the total value of BCD Limited resulting from acquisition. So what is their value with merger and what is their value without merger is what we would like to calculate. Increase in value for BCD Limited, that is for target. So with merger, what is the price? Without merger, what is the price? Now without merger, I mean before merger, their share price is 20 rupees they have given. Now if they go ahead with the merger, then what is likely to be their thing? Because they have information on dividend and growth rate, you know what we should follow? Dividend discount model. But dividend discount model requires cost of equity. We don't have cost of equity information, so let's arrive at that cost of equity. Based on the dividend and based on the current market price and growth rate, let's arrive at the cost of equity. And let that one, we will make use of it. I'll do it in the separate slide, next slide. So increase in value of BCD Limited is what they're asking, and that is nothing but target. So what we are going to do, value of company with merger, value with merger, and what is the value without merger. The difference becomes the increase in value. What is value without merger? That is market price multiplied by number of shares. So what is the market price of target? 20, number of shares 5 lakh. 20 rupees 5 lakh. So you get 100 lakhs value without merger. Then what is the value with merger? For that we need cost of capital. So cost of capital can be calculated as D1 by P0 plus growth rate. Dividend information available, which is 0.6. P0 market price today 20 plus growth rate. Expected growth rate of AFC, not AFC, BCD 7%. 0.07. think you get 10%, that is 0.1 or 10%. And this cost of equity will remain same. Cost of equity, will take it as 10%. But P0, price would change, because when you are going to be part of new entity, the growth rate will change, and growth rate will take it as the new rate. Growth rate 8%, because now you are going to be part of acquirer, and acquirer growth rate will be applicable. Expected growth rate under the control of AFC Limited. Oh, sorry, I think I wrote 8% wrongly under the heading of AFC Limited. So please don't write 8% like this. Within brackets, you can write 8% with merger. Are you able to get it? That point? 7% is your current growth rate under the control of AFC Limited. So that is after merger, the same unit, because somebody else manages it, growth rate expected to be higher. So what we are going to calculate? Revised price, revised P0, that is D1 by K minus G. Dividend expected 0.6. KE remains same 0.1, but growth rate will be 8%. So 0.6 by 0.02. I think you get 30 rupees. So value with merger, MPS 30 rupees, revised price. The value will increase, or without merger, your market price 20, with merger, because of increase in growth, value of the company will increase to 30 rupees into number of shares, 5 lakh. So 150 lakhs. So increase in value, 150 lakhs minus 100 lakhs, that is 50 lakhs. Okay. Shall we go to the impact of merger, second part of the problem? See, in this problem, we are not going by P ratio method. So in fact, so this data point, P ratio, we are not doing. We are going by the dividend growth model method. Okay, so let me go further. Second part of the question. On the basis of the aforesaid conditions, calculate gain or loss to the shareholder of both the companies if they were to offer 1 share for every 4 shares of BCD Limited. Swap ratio 1:4. Then impact, basically you have to calculate impact of merger on market value. Market value, no. Gain or loss to shareholders of both the companies. So they have not given. When they have not given, we'll go for market value. Impact of merger on market value of holdings. We are going to calculate for acquirer and as well as target. Both are required, is it? Both the companies, no? To both the companies. And you know the formula what we have to calculate? MPS, I mean for acquirer shareholder, MPS after merger minus MPS before merger. But for the target shareholder, MPS after merger multiplied by swap ratio, then you subtract with MPS before merger, MPS of target. But what is MPS of merged entity? And if you remember, we used to calculate by earnings EPS of the merged entity multiplied by P ratio. P ratio method is not applicable here. And therefore, what we do, market value of the acquirer plus market value of the target is what we are going to use. So let me calculate. Market price per share of merged entity is calculated as market value of acquirer plus market value of target divided by number of shares of merged entity. We are not going by P ratio method. That is a difference as compared to regular problems. What is market value of acquirer? Number of shares is 10 lakh, market price 100. Oh, I think we can go and calculate, but here only we'll do it. That's fine. Or have they given the problem? No. Market price multiplied by number of shares. Market price 100, number of shares 10 lakh. So market price hundreds, number of shares 10 lakh. And for targets, market price, revised market price will take, which is 30. Number of shares 5 lakh. I think 150 we already calculated. Yeah, that 150 lakhs. That number I can take it as it is. Divided by number of shares, existing plus issued. Existing number of shares 10 lakh plus issued based on swap ratio. Number of shares of 5 lakh multiplied by swap ratio. I think 1:4. So this is 1000 plus 150 lakhs divided by 10 lakhs plus this is 1.25 lakhs, I think. 5 lakh into 1/4. So 1150 lakhs by 11.25 lakhs. I think that is 102.22. And then, impact on acquirer shareholder, then impact on acquirer shareholder, on target shareholder, on acquirer shareholder is MPS of merged entity minus MPS of acquirer. MPS of merged entity 102.22 minus target, acquirer market price was 100. So gain of 2.22. Similarly, target shareholder, MPS of merged entity, but here we don't simply say merged entity, we'll have to multiply it by swap ratio minus MPS of target. Merged entity 102.22 multiplied by swap ratio 1/4. Target company share price before merger was 30 rupees, or okay, we'll take it 20 rupees. I mean, before merger actually it was 20 rupees, the market price. So 102.22 2 into 1 by 4 minus 20, 5.55. Okay. Sometimes institute, what does they do? In fact, for this solution in RTP, they have multiplied this 20 with 4 rupees and they kept 102 as it is. Means this is the 5.55 share for every shares held in target company. But institute, what they did, they multiplied this number by 4. So 102 minus 80, you get 20 something. That's for every shares held in acquirer. 5.55 into 4, the 20 point something will come. You can express in both ways, but this is the standard one. I would recommend you go with this standard one. Okay, so last part of the question. So last part of the question. Okay. Calculate the gain to shareholder of both the companies if AFC Limited pays 22 of BC Limited, assuming P ratio does not change. Oh, P ratio does not change. So meaning, first of all, P ratio. When we don't have information on P ratio, we'll go by 1 by cost of equity as information. If you have information cost of equity, but anyway. The third part of the question, settlement is not happening by shares but issue on cash basis. And assuming P ratio remains same, so let's go by EPS multiplied by number of shares, you get earnings. Then we are going to add we are going to consider the P ratio. P ratio we can calculate because you see EPS they have given, and market price per share we know 100, so we can calculate the P ratio. Okay, so third part of the question, if settlement is by paying cash of rupees 25, right? 22, sorry, 22%. $22 per share, therefore so we'll calculate what is the market price after merger, but EPS multiplied by P ratio. We need market price after merger EPS of the merged entity multiplied by P ratio. Okay. EPS of the merged entity, how do we do? Earnings of the two entities, we know number of shares, we know EPS. Number of shares 10 lakhs, so EPS 8. 10 into 8 plus 5 lakh into 2.5. 5 into 2.5. So we know the earnings of the two entities divided by number of shares does not change because you're paying cash. No synergy benefits, 0. Then multiplied by P ratio. P ratio is existing P ratio, market price per share by EPS. Market price per share 100, EPS is 8. So 100 by 8. So that is 5 into 2.5 plus 80 divided by 10. 9.25. 100 by 8. 12.5. The market price 115.625. Please check if my calculations are fine. Okay, that is there. But one more small point I forgot to take. That is, there is an opportunity cost. In the sense, indirectly, if you want to pay consideration, you have to pay 20 rupees, right? When you pay 22 rupees, indirectly they said you can earn 10%. You can treat this way. If you want to pay, you need to pay interest. If you are paying in cash, if you invest elsewhere, you can earn income. If you don't invest, you lose that opportunity. So to that extent, the income will come down. Or other way around, you can also understand for the paying so much, I have to take a loan at 10%. So please subtract 22 multiplied by number of shares. Number of shares is 5 lakh. So you have to subtract this minus 22 number of shares is 5 lakh plus zero synergy benefits. So this is 22 into no 10% into 5 into 10%. 22 into 5 into 10% into 5 into 10%, 11. So 80 plus 12.5 minus 11 divided by 10. 8.15 into 12.5. 80 plus 12.5. I think if you simplify overall, you get 101.875. Hope you get that. 101.875. Okay. Then impact of merger. On acquirer shareholder. Target shareholder. Acquirer shareholder is after merger 101.875. Before merger is I think 100. So gain of 1.875. And target shareholder, please do not take 101.875. They are not getting shares. They are getting directly 22 per share. Okay, please be careful about this. You don't do 101.875 into swap ratio. Swap ratio is not there. Settlement not by issue of shares. Settlement by paying cash. So 22 minus 20 rupees. So gain of straight away 2 per share. So this is the completion of this merger problem.